Parliamentary Joint Committee on Corporations and Financial Services into Small Business Insurance. I begin today by acknowledging the traditional owners of the land on which we meet, and I pay my respects to their elders past and present. I extend that respect to Aboriginal and Torres Strait Islander peoples here today. The committee will be conducting today's hearing in person and via teleconference. These are public proceedings being audio streamed live via the Parliament's website, and a Hansard transcript is being made. I remind all witnesses that in giving evidence to the committee, they're protected by parliamentary privilege. It's unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee, and such action may be treated by the Senate as a contempt. It is also a contempt to give false or misleading evidence. Witnesses also have a right to request to be heard in camera. If a witness objects to answering a question, they should state the ground upon which the objection is made, and the committee will determine whether it will insist on an answer, having regard to the ground which is claimed. If the committee determines to insist on an answer, a witness may request that the answer be given in camera. I remind any committee members and witnesses who are appearing via teleconference to mute their microphones when they are not speaking. Just before I welcome our first witness, can I just indicate that in conversations with colleagues and with representations made to our officers, clearly many people in business are talking to us about concerns about the insurance sector, access to insurance and the price of insurance. It is my sincere hope that the inquiry of this committee will outline the shape and form of the challenges that face Australian businesses and Australians in general with regard to access to and the quality of insurance and the pricing of insurance, and that we might find amongst those who give us evidence sustainable solutions to the very real challenges that we face as a nation. So with those words, can I now welcome Mr. Damien Rinaldi from the Australian Music Publishers Association. I understand that information on parliamentary privilege and protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full name and the capacity in which you appear today?
Damien Rinaldi, Chief Executive Officer of the Australasian Music Publishers Association Limited, also known as AMPAL.
Thank you very much. And for those who might be listening along, can I just give my colleagues the opportunity to introduce themselves? We might start down the far end there with you, Mr. Buchholz.
From Queensland.
Senator Dave Sharman, New South Wales, Senator.
Madonna Jarrett, Federal Member for Brisbane and Queensland.
And I'm Deborah O'Neill, Senator for New South Wales and the Chair of this committee. I now invite you to make a short opening statement, and at the conclusion of any remarks, I will invite... Oh, we've got people online. Sorry. Miss Lawrence, did you want to introduce yourself?
Thank you. Good morning. I'm sorry I was not able to be with you this morning. Tanya Lawrence, the Federal Member for Hansard in Western Australia.
Thank you very much. I now invite you to make a short opening statement, Mr. Rinaldi, and at the conclusion of any remarks, I'll invite members of the committee to ask questions.
Thank you. So AMPAL represents about 60 music publishing companies across Australia and New Zealand. From major global publishers to small independents, our members share one purpose: to protect, promote and license the works of songwriters and composers. Relevantly for today, the majority of these member companies are based here in New South Wales. From an insurance perspective, music publishing is neither a service regulated by statute, like, say, the legal profession is, nor is it inherently dangerous, as, say, a CD manufacturing plant might be. In fact, as an exclusively white-collar discipline, music publishing arguably involves the lowest insurable risk of all music industry activities and much less risk than, say, the music festival sector. And yet, the majority of music publishers are subject to materially higher workers' compensation premiums than their counterparts in other states and territories, in some cases estimated to be 2 to 3 times higher. This is due to a perplexing and overly broad classification in New South Wales that assumes manufacturing is involved in music publishing, which it isn't. While AMPAL submits that there are simple ways to fix this problem and that these fixes are state-based, AMPAL also suspects that encouragement and guidance from federal counterparts would greatly assist in these solutions being adopted by New South Wales. As a final comment, I alluded earlier to the higher risk profile of live music, including music festivals. Our written submission formally expressed AMPAL's strong support for the submission and recommendations put forward by the Australian Live Music Business Council, or ALMBC. In this regard, I note ALMBC's observation that substantial insurance premium increases, declining margins, and rising operational costs have contributed to venue closures and a contraction of live performance opportunities across the country. This has downstream consequences for music publishers and songwriters whose works depend on live performance for both income and audience development. AMPAL is grateful for this opportunity to be heard and commends this committee for its interest and efforts to review the insurance regime so that it best serves the Australian music industry.
Thank you very much, Mr. Rinaldi. One of the things about insurance is that when the risk is spread across a larger population, the sustainability of insurance becomes a reality. That's kind of how the whole industry was conceived of. In your argument is embedded a differentiation for part of the music scene, and you've made a very strong case for that. How does that sit with the broader the risk, the lower the premiums, as far as you're concerned?
Okay, so there's probably two segmentations that are relevant here. One is the activity, which is music publishing, as compared to other activities in the broader music industry, and the second one is territorial or geographical. So in this case, specifically New South Wales. So in relation to the first one, the spreading of the risk, I guess the response to that would be that music publishing as an activity, and it's well defined in the ANZ SIC classifications by the Bureau of Statistics. So if you're ever looking for a really good summary of what's involved, those codes, which are used as the basis for insurance in all states, workers' compensation insurance in all states other than New South Wales, those codes, those classifications do very precisely set out what music publishing is. And the interesting thing about those codes, relevant to your question, is that they're quite granular. That's the problem in New South Wales, is that it's not so granular. That granularity, I think, is appropriate because the activity of music publishing is, as mentioned earlier, exclusively white collar. So there's unlikely to be physical injury from a workers' compensation perspective in music publishing versus other sectors. I mean, obviously, music festivals, there's a lot of moving parts physically. You know, a CD pressing plant, literally there is machinery that is going consistently. So spreading the risk, I mean, I think the answer to that would be that the inherent risk in music publishing, though, is very low. And then from a territorial perspective, I don't think there's anything really that is unique about New South Wales when it comes to the white-collar work that we do. In fact, we probably see ourselves as an industry that's very global because typically copyright operates on a global basis, and most music publishers think of themselves as being in a business that really doesn't have borders or isn't affected by borders in terms of the collection of income from the exploitation of those copyrights.
Thank you very much. You've made the case, I think, quite clearly that AMPAL itself is not a high-risk insurance user.
No.
But can you explain, like, the outworkings of this? What are the consequences in terms of instability in the live music insurance markets? And how does that affect music publishers and songwriters actually in practice?
Yeah, sure. So the higher the costs to operate live music, the less likely that operators in that space will operate. It will impact on their ability, their resources, their bandwidth to conduct concerts, festivals. That will in turn impact on the prevalence of playing music. So less festivals or less live performances equals less music getting played. and that equals less income being derived from the playing of music. And I guess just to sort of round out that picture, when a performer performs a song live, a royalty is paid to a collecting society known as APRA AMCOS, which is in turn paid on to publishers, music publishers, and songwriters. So if those performances disappear, that income disappears, and that impacts on music publishers and their clients, who are typically songwriters.
What surprises me in the reading that I've done in preparation for this inquiry is the specifics that you're speaking about with your particular industry are still are very much echoed in other industries. There's a sense of shrinking of particular sectors as people just go, the cost of insurance is making it too difficult for this whole ecosystem to properly function. Was there a glory days? Like, was there a moment where things were working better, and what was relevant that we should think about?
From a specifically workers' compensation perspective, or more broadly in the industry?
Whatever way you think is going to give the committee the most information, Mr. Rinaldi.
Certainly, I think from a live, and it's really not our remit, but I guess from a live music perspective, and I'm hearing this anecdotally a lot, the insurance, the significant increases in insurance, even at a grassroots level. I have a brother in Perth who operates bookings for a venue there, and I know that ended up closing because the cost, I mean, as it was told to me anecdotally, was tenfold, and I'm not sure if that's true or not, but it was so prohibitive that it ended up it was just unviable. So certainly anecdotally over the last 5 years, that's been a recurring theme. I think there was a disruption during COVID as well. I mean, that was obviously from a live perspective, that business completely died. There were inventive ways in which the industry tried to get other things going, live streaming, which has never really completely replaced the experience of live. I think there was a bit of a bounce back post-COVID, but I think it's still, I'm hearing it anecdotally again, the American act Pussycat Dolls only a couple of days ago announced the cancellation of the European tour. So we're hearing a lot about it being really tough times for live performances, unless you're Taylor Swift and you're huge. That's probably, I know, getting away from small business insurance, but there are, when you add the complexities or the challenges of small business insurance to that picture, that's just another nail in the coffin, I guess, in terms of that. And the live industry, and again, we don't represent them, but it is very much an industry that has a lot of people downstream who feed into it. So, our writers write the songs that get performed, but then derive income in return from it. When an operator decides to set up a festival, that's good news for music publishers, because that's another forum for the songs that we represent to be heard and monetised.
I'll just have one more question and then I'll come to colleagues. You expressly support the ALMBC's recommendations. Of those proposals, which do you regard as the most urgent for stabilising the live music ecosystem, and why? If you need to give me 2 or 3, I'm happy to do that, but in a hierarchy would be helpful.
Yeah, no, look, and it's a difficult question to answer off the cuff. I'm happy to do it if you like. It would be probably preferable to do that on notice, but...
Well, you can certainly add further information on notice, but if you want to just give us a bit of a shape and form response now, that'd be great.
Yeah, sure. Okay, well, look, I'll do my best. So I'm just going to look at our proposal there. I mean, I will say that as a place to be looking in terms of the minutiae of this, and I know that some of the people behind that submission, and the reason we were so supportive of it, are actually heavily involved in the insurance industry. And so therefore there is a level of expertise that's well beyond mine, and a level of interest that they have that's well beyond AMPAL's, that I think is one to really sort of take notice of. One that I thought was interesting, and I don't know if I'll necessarily say it's the primary one, but the improved transparency of de-identified claims to ensure policy settings reflect actual risk profiles rather than outdated assumptions, I felt like a practical solution. I mean, it's short of there being.
What do you mean by outdated assumptions there? What does that actually mean in practice?
Yeah, no, look, and again, I'm probably not best placed to answer that, but in terms of outdated assumptions, I mean, when I guess insurers, but also operators as well, are looking to manage their risk. It doesn't necessarily. Insurance may not necessarily be the only solution. There may be steps that that those operating in the live music sector can affect risk management themselves outside of just insurance.
Yep.
And I think there is data, and obviously anonymised, that would be useful from a perspective. I mean, I find that even, for example, in the legal industry, the professional indemnity insurer will also obviously set up programs for the insured to be able to manage their own risk such that claims are going to be less. And I think when they talk about the identified claims data, they're looking for an opportunity to themselves contribute to the lessening of risk in the first place.
Yep.
So that, to my mind, it's a practical solution, but I don't believe, as I understand it from their submission, that de-identified claims data is available to them.
In addition to not being available, have you ever seen insurance premiums decrease as a result of identified risk being mitigated?
No.
Which is kind of interesting. The other thing I want to raise, if I can, as a consequence of your evidence so far, is with regard to insurance, we keep hearing how tight the market is, how difficult it is, but we also hear that there's significant profits being made. Have you or your entity in the music done any analysis of, the cost-benefit ratio to you of changing premiums?
No, we haven't, is the short answer. But your comment prompts me to recall speaking with the ALMBC, and one of their concerns, I guess, was probably the low number of choices in terms of insurers. Right. For the insurance that they're looking for. And I think they've made that comment comparing themselves to other territories where they're bigger territories, obviously.
Other jurisdictions overseas?
Correct.
Yeah.
But more choices, it's an easier proposition overseas because there are more operators, and so it's a more competitive market. Yeah. So I think as I understand it, because we are a smaller market, and I don't know if there's much that can be done about this, but there are smaller choices, and it becomes more difficult for them.
Yeah. And we'll be investigating the shrinkage of competition despite the proliferation of product as we continue with the inquiry. I'll go to one of my colleagues from down that end of the table, Senator Sharma.
Yeah, thanks, Chair. Thanks, Mr. Rinaldi, for your submission and your appearance today. I just had two questions I wanted to pursue with you, following up from your submission. One was this specific concern you had with respect to New South Wales. As I read your submission, it's the lack of a classification that other states and territories use of a specific music publishing category, which means that a music publishing business in New South Wales is assessed as a high risk activity, I guess. So I think you'd say in your submission here that the result of that can be that workers' compensation policies are 2 to 3 times more expensive in New South Wales than in Victoria, say? Is that?
Yes.
That's right. So I don't know the business very well, so what's like a garden variety music publishing business in New South Wales? How many people would it employ? What does it turn over? And what's it paying in workers' compensation?
Yeah, sure. Unfortunately, I'd probably have to take that on notice to give you some numbers there. But in terms of size of organisations, I mean, look, it can be anywhere from 1 or 2 people to probably the largest music publishing company would potentially about 25 people.
Okay.
So they're not large businesses.
Okay. And how many members have you got altogether? So how big is the
We've got
industry in
60,
Australia?
and that's across Australia and New Zealand.
60 across Australia and New Zealand. And that's most of the industry or all of the industry?
Most of the industry.
Yeah, okay. Okay, so it's significant. If they're paying an insurance premium that's 2 to 3 times higher, that's significant. Have you had any conversations with the New South Wales government or your industry about this issue? And what have they recognised it's a problem? Have they offered to do anything to fix it?
Yeah, no, it's a good question. So the short answer is yes, we have. So we started with the Minister for Music and the Nighttime Economy,
Right.
His office, and through that office we were put in direct contact with iCare.
Okay, with the workers' compensation providers for New South Wales.
For New South Wales, correct. It would appear that New South Wales is, at this stage, committed to having its own sui generis classification system. So they don't use the ANSIC classification codes, and they appear to be, their codes seem to be much less granular, and that sort of makes sense in it. You've got a system that's been set up by the Bureaus of Statistics for both Australia and New Zealand, and they do go down to a level of granularity that I think is satisfactory. New South Wales doesn't use that, it uses its own, and therefore it has much less granular.
I see.
So we're lumped in with
Higher risk activity, like
including
CD.
yes. So the exact name of our classification is recorded music manufacturing and publishing. Now, I guess intuitively when I look at that, it actually seems like it's probably wrong, because we're not in the business of recorded music, we're in the business of the underlying songs that get recorded. So and the ANSIC codes recognise that, because there's a separate code for recorded music, and we're certainly not in any business of manufacturing. So we're not in CD manufacturing, and even under the ANSIC codes, printing of sheet music comes under a different code. So again, it's granular, and it does focus on just the work that music publishers do, which, as I say, is probably as white collar as you can get. There is a code that the New South Wales has that's probably more important, more relevant. It's agency services to the arts, which comes with a much lower rate.
I see.
But at this stage,
you haven't been successful.
We haven't been successful, no. I believe New South Wales government at this stage has other priorities that it's doing at the moment. That's for them to talk about, obviously. So they're cognizant of the issue. They have suggested that maybe members on an individual basis might want to get an individual review for their own.
iCare?
Yeah. Okay. So that avenue is available, but it is still, I guess, inherently wrong, which is why when this inquiry came up, it seemed like an appropriate moment. It's not necessarily, your problem to solve, but it is a situation where there is essentially discrimination on a territorial basis within Australia on this issue, which I guess would be of interest to you.
Yeah. No, I think it is of interest. It is of interest. Thank you for that explanation. And then the other area I just wanted to pursue or get a more detail from you is, you mentioned in your submission your endorsement of the ALNBC's submissions recommendations for targeted tort reform measures to reduce disproportionate legal cost escalation. So what are the possible measures that you have in mind there for targeted tort reform?
I'll be honest, that is probably more ALNBC's fight to have.
Okay.
We're supportive of, given their position, as we described before, and the downstream impact that it has on us, that we're supportive of anything that they are wanting to do that will increase their activity and which will in turn help increase our activity.
I see, okay. Yeah. So this is more an issue for them than for you, but it will...
Yeah, and I know that they're keen to present when the opportunity arises.
Yeah, okay. All right. Thank you, Chair. That was all I had.
Thank you. Ms Jarrett, you have the call.
Thank you, Mr Rinaldi. I just wanted to clarify something. You talked about the territorial discrimination. What did you say the difference in insurance costs is, say, if I'm a publisher in Queensland versus in New South Wales?
So look, it can be anywhere between 2 and 3 times more in New South Wales than it can be in other states. I mean, to use your example, I think the gap is probably narrower between Queensland. I mean, to give you probably an extreme example, and these are figures that were taken from September 2025, so they may be, given the inflection of time since, slightly out of date. But just to give you an example, in Victoria, the relevant rate for music publishing was 0.397%, so almost 0.4%. In New South Wales, it's 1.35%. So I think in that instance, it's actually more than 3 times. Queensland, just for roundness, is 0.679%, or was as at September 2025. So the New South Wales rate in that instance is double the Queensland rate. And the nature of music publishing and the music business more generally, you find is sort of concentrated towards New South Wales. I mean, it's not uncommon for businesses to have their head offices in Sydney. When they have the ARIA Awards, they're typically in Sydney. So the industry is very Sydney-centric, hence why we have a majority of our members based in New South Wales. So, it's a disproportionate... Unfortunately, it's not just one of those issues where we could shrug our shoulders and say, oh, that's just unfortunate for those in New South Wales. It actually has a disproportionate effect given the makeup of our industry.
Yeah, and you mentioned earlier also that it's really the big changes in cost increases have happened over the last 5 years. Is that correct?
I don't know if I'm qualified to comment on that because I haven't done the research in terms of insurance. This is probably more just the discrimination between states, and that's probably the area that we've primarily focused on.
Yeah.
But the likes of ALMBC, I think it would be better placed to talk about that.
Okay, and so do you have any anecdotal stories? So when your members talk to insurers, what are the insurers telling them in terms of? I mean, I understand the territorial difference and the difference in the coding, etc. Yeah. But in terms of what's happening in the market, what are your members telling you, and maybe in terms of choice or product availability, and what are the insurers telling them?
Yeah, no, look, it's a good question, but the answer is that our members are probably not telling us a lot other than those in New South Wales saying we seem to be paying a lot more, and that obviously involves one type of insurer, workers' compensation insurer, and that typically tends to be a statutory thing, and so therefore it's not really about sort of choice of products in the market.
Yeah, okay, I understand what you're saying. Thank you. That's all true.
Thank you. Mr. Buchholz, you've got the floor.
Thanks, Chair, and thank you, sir, for appearing. Can we just tease out, on the back of some of the questioning from the Chair and Senator Sharma, do you have any work on your workers' comp? Do you have any claim history?
So I'll just get this one out of the way. So AMPAL, no. And then in terms of claim history across our members, I would have to survey our members to find that out. So I don't know the answer to it.
Because at face value, I would have assumed that the core of who you represent, the guys writing tunes and publishing them, would be a fairly low risk, as opposed to road crews setting up stages and falling off stage at 3 o'clock in the morning after probably one or two many flat lemonades.
Yes, that's right. And I think, I guess, just to expand on that, the insured in our instance probably aren't even the songwriters. They're the people doing the music publishing work. They're typically working in an office or maybe working from home. And with no real moving parts or heavy machinery and generally done in the one place. So, the risk is very low. And I think if I was to speculate as to how many claims there would have been from a workers' comp perspective, I would have thought they would be minimal, and I would have thought they'd be in line with, a white collar industry, office workers.
I would suggest that when you revisit with the New South Wales government, that you and others arm yourselves with that vital piece of evidence, because it's powerful.
Yeah.
If you're going in there asking for a rate reduction, every assessor, when they are valuing the risk, they do a private risk assessment, and if you're offering data because they've got you bundled in with a high risk sector and you can carve out that bit of space, I think there is a light at the end of the tunnel for you. I think it needs to be evidence-based, and as you rightly point out, those decisions are not made in this environment, but in other jurisdictions. And I wish you well with your endeavours.
Thank you.
I think there's a light at the end of the tunnel there for you.
Yeah, appreciate that.
Thank you. If I can just go to, again, the Australian Live Music Business Council said that it investigated the potential for a mutual insurance model and found it would not be sustainable. Are you aware of that investigation, and is there an alternative model that you believe would be sustainable?
Again, I'm afraid that I'm not.
We'll probably call the ALMBC.
Yes, and I think they, having spoken with them only yesterday to find out if they were appearing today, I know that they're keen to be heard.
Great.
But I believe that their official address is in Queensland, and that might be a good reason why they didn't appear today.
Okay, yeah. But they have a presence in Sydney by the sounds of things.
Their chair is in Sydney.
Okay.
Yeah. So.
Great. All right. Well, that's helpful for us to know as we plan further hearing dates and opportunities.
Yeah.
Some submitters refer to evolving workplace risks, including your understandings of psychological injuries, as being factors that have contributed to increased insurance premiums. How have these factors changed the calculation of risk in your view with regard to your particular sector?
Psychological factors? Again, not being in the sort of insurance or actuarial space myself, very difficult to speculate. I think it's probably worth saying that there is a greater awareness of these factors. I guess it's a bit of a mystery to me how that sort of feeds itself into risk assessing and then insurance pricing.
It's a sort of mystery black box that we're not quite clear about yet. So hopefully we'll get some evidence with regard to that.
No, exactly. But probably the one useful thing I could say is the music industry embraces a charity that is from within its ranks called Support Act.
Yes.
And I know Support Act have in recent times, I think they've set up a hotline for those in the music industry who've fallen on hard times and may need that sort of support. They've had social workers and psychologists, I think, in the frame for a while now, and they might actually be a good place to be sort of directing that question, because they're probably more advanced with the thinking there than we are. But I don't know if they're. I don't believe they made a submission, because I looked at those who did, but it would be interesting to get their views, I think, about the question that you asked.
Yeah, and have there been any insurance flows through to them or to clients that they're helping with any mental distress?
Yes, no, exactly. So they are probably closer to the action than we are, because insurance, as I say, because we're such a low-risk industry, insurance doesn't really come up much in the conversation with our members. And it was this anomaly and the awareness of it that I think prompted our members to start making a bit of noise about it, which is usually they're focused on other factors other than insurance. Okay. And again, because this inquiry was being held, it seemed relevant to at least put this on your radar.
Yeah, look, it's really good evidence to kick off with, because the whole thing is quite complex, and often in the midst of complexity, there's a lack of clarity around things that can happen. So this is part of teasing out the challenges, I think, that exist with regard to insurance. Who's the major provider of insurance to your sector, and is it provided through brokers or direct insurance?
Now, we're talking more generally about insurance?
Yes.
Yeah, look, again, I'd have to survey our members to get an answer to that, which I'd be happy to do. but I couldn't tell you off the top of my head. And of
That'd be
course,
quite helpful.
yeah,
To see if there's a concentration of provision, because we have we haven't heard yet, but in the evidence there's some uncertainty about how to access brokers by different people across different sectors. There's some assertions that brokers provide really competitive responses to the challenges, and there's some evidence that indicates that brokers just seem to have almost a monopoly in particular areas, and there's one provider that's preferred. So, if you could give us the shape and form of who's providing the insurance, and have they been questioned about the insurance and risk ratings? Like, what's the conversations like going up and down the food chain, or people just they want the product. There's one monolithic product, and it costs this price, and you're either in or out, and there's no differentiation for proper risk-weighted need, which could increase the cost. Who knows? But I'm very keen to get the facts of what's actually happening.
I'd probably say two things in response to that. One is obviously with workers' compensation insurance, that's fixed as to who you're using. The second one is some of our members are multinational publishers, and I think insurance would be global and driven and managed from head office. And so therefore, whoever they use globally is probably the broker that they use. So I guess you just have to factor that in as well, that they would see those global publishers would see it from a global perspective, with Australia being included. So probably the more meaningful answers will come from those who are the head office here and who make the arrangements from here. Yeah,
and also a comparison between what the options are for those who are domiciled somewhere else.
True.
Yeah, okay. Any further questions, colleagues?
From me, Chair.
No, in that case, look, can I thank you, Mr Rinaldi, for being the first brave one to kick us off. And the committee will now suspend for a morning tea break and return at 10:45 with Finity Consulting.
Thank you.
Thank you. Resume and recommence with representatives from Finity Consulting. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to the Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacities in which you appear today?
Pravesh Ponna, Principal Affinity Consulting.
Susie Amos, Principal Affinity Consulting.
And you have the senators and members that you can see here before you, but we also have Miss Lawrence joining us from Western Australia by teleconference as well. I now invite you to make a short opening statement. At the conclusion of any remarks, I'll invite members of the committee to ask questions.
Thank you, Chair, and thank you for the committee for the opportunity to appear today. So I'm Pravesh, and with me is Susie Amos. We're principals at Finity Consulting. Finity is an actuarial and analytics firm, and we work with insurers, reinsurers, and regulators across the Australian general insurance industry. Our submission to the inquiry was was factual in nature. It draws on publicly available industry data, including APRA statistics and our optimum market analysis. And this describes how the insurance markets impacting small businesses have been performing over time. We have not made any policy recommendations, and we're not advocating for any particular outcomes for insurers or governments. As a result, the scope of what we're best placed to assist the committee today with is quite specific. We can explain how the market is functioning at a system level, and that includes premium trends and claims trends, to the extent they're visible in the data. We're obviously not an insurance company. We do not set premiums, and we do not make underwriting or product design decisions. So where questions go beyond market level observations into individual products or customer outcomes or policy choices, we may only be able to respond at a high level. With that framing, we're happy to take questions and assist the committee as possible.
Thank you very much. I mentioned to the previous witnesses that we've had a lot of incoming to the committee about rising costs of premiums. And some extraordinary claims about, doubling and tripling of the costs. You paint a much more nuanced version of what's happening in the insurance sector. Could I ask you to put on the record what you see in terms of premiums trends? But perhaps we might start with claims trends first. Thanks.
Sure. Yeah, our observations or the data that we look at is market level data, so it doesn't look at particular segments, it looks at the overall market. And what we have observed is that the claims costs over the recent history has been increasing, and the premium increases have followed in response to that. And there would
So there's a sequence there that you're very deliberately ordering. So premiums at one level, no major rises, claims, then rises. Is it absolutely the case, or is there potentially just profit taking? Is there a cause and effect happening here?
In our observations, the premiums are there to cover the cost of claims and expenses to provide that service to the customers, and the premiums reflect that those expenses and claims. And so we have seen that there has been claims cost pressures in the industry over the last few years, and with that is premium responses to that.
Okay, so claims cost pressures in the industry, are they in particular segments of the insurance market?
We can talk at an overall product level. So we talk about property insurance versus liability or financial lines, and it's fair to say that there's been claims cost pressures in most of those total product levels. So obviously in property insurance with inflationary pressures, as well as in the liability and financial professional indemnity space, there's been claims cost pressures.
Okay, so in terms of this committee and our determination to sort of outline the shape of impacts, particularly on small business, could you speak then to the liability dimension of the insurance market and give us some sense of the timing of what you've asserted is rise in premiums and a compensatory adjustment to the cost?
Susie, you want to take that one?
I can take this one.
Sorry, rising claims and then cost rise, yeah.
Sure. So what we observe from, and we put in our submission to the committee from publicly available information is increase in claims costs, reserve and claims deterioration. That has been happening, what we've seen over the last 5 to 10 years. And what we also observe and draw out in our publication is how that relates to the insurer's sort of profitability and returns. And in that regard, you can see from our publication that insurers are sitting sort of within their target profitability range, sometimes above, sometimes below. That varies over time with the market cycle, and a target profitability range is noted to be 10 to 15% return on equity within our publication.
And that 10 to 15% profitability is something that many small businesses would absolutely love to be achieving. But, you know, I can think of the construction sector where people are down to margins of 1.5%. What is your view about a profitability margin of 10 to 15%, and how does that compare with other jurisdictions?
So a view is something that we probably can't provide today. We're here in the capacity of providing facts around the statistics, so that's something that I probably couldn't answer.
If you could take on notice what the data in terms of 10 to 15% profitability expectation in Australia is by comparison to other jurisdictions. Is that possible?
Oh, yeah, we can take that on notice. So, yeah, around the world.
Correct.
Yeah, sure.
Can I just add to that?
Please.
While
Mr.
you're pursuing that data, can you just go back over a period of 10 years? Because my line of questioning was going to be, has the margin increased over a period of time while we've been ratcheting up, or has it always been that level?
Sure. Yep. We can take that one on notice. It definitely does change over time with the cycle. Yeah. And we can give you more detail around that shape and the timing.
10 years the right period of time with the cycle, or should that be longer?
It's a good question around market cycle. If you look more broadly across the world, 10 years has been sort of an average cycle, but it does vary by jurisdiction and even by class of business. So
I'd just be interested in the Australian market rather than setting too high a homework task for you.
Yep. 10 years is just sort of a long-term view. We can provide you with, as long as we have statistics available for.
Great.
Thanks, Chair.
Thank you, Mr. Buchholz. With regard to the cycle, my understanding is that the insurance market operates in cycles alternating between soft or buyer-friendly markets and hard insurer-friendly conditions. Of course, in the soft market, there's lower premiums, high capacity and relaxed underwriting, while the hard market brings higher premiums, strict underwriting and reduced capacity due to increased claims or economic factors. If you can just give us your sense of what's been going on in the terms of hard, soft market over that 10-year period, for example, generally.
In respect of liability?
Yes.
Yeah. So if we sort of take the 10-year period, we've had post the previous tort reform, early 2000s, that there was a sort of a significant soft market over that period.
So let's just tease that out. Soft market, buyer-friendly, as a response to tort law reform, which is 20 years ago.
It aligns with that same period, yes.
Yeah.
maybe this question aligns and links quite to the question that was asked over there. I wonder if we can sort of take that on notice and provide the response to this, which would actually give sort of much more clarity rather than me sort of guessing timing.
Fantastic. Thank you very much, Ms Amos. I've got another couple of questions, but I'll go to one of my colleagues if there's an indication of interest. Mr Sharma?
One interest, but I've got one question if I could. I just was interested in your submission. So good morning, nice to have you here. Your submission regarding, or the content in your submission regarding workers' compensation claims, and particularly those with a psychological component having contributed to increased claims costs. I've seen, at least anecdotally, particularly here in New South Wales, concern about, there's been an active concern about the viability of the workers' compensation sector because of the rise in those sorts of costs. But what are you seeing at a macro level across Australia in terms of compensation claims with a psychological component, in terms of level of growth and prevalence and industry concentration and the like?
What we've seen in workers' compensation and in liability, that the claims cost is increasing over and above economic inflation levels.
Okay.
And the data is a bit sparse. It's better in workers' compensation than liability, but what we from our work and what we sort of put in our publication, psychological injury claims are sort of cited as part of the reason, or possibly part of the reason for that. Some of the drivers around that are sort of longer claim duration and sort of higher sort of damages being awarded for those types of claims.
And have you got a figure for the sort of growth of those? I mean, are they growing at like single-figure percentages a year or two-figure percentages? What?
So we can come back. We haven't noted in our publication. We can come back on publicly available information which that is available on workers' compensation.
Okay. And so how would it work in, I understand obviously how it works in workers' compensation. How does it work in liability? I mean, what's your garden variety case where someone is claiming damages with an entirely psychological component on the basis of a liability policy? Can you just give me a scenario so I can understand how that might arise?
So for liability, it's often a secondary injury. So they may be physically injured, sort of in a negligence case, and at the same time they also experience damage in mental harm. So it's the mental harm component.
So like a fun park accident, for argument's sake, or something like that, where they have physical injuries.
Physical injury is a mental,
and then
injury component.
Understood. Okay.
Yep.
And then it can also extend out to family members as well.
Okay.
That cause that.
For nervous shock
Nervous
claims.
shock.
That's quite common in medical malpractice.
Yes. Okay.
For nervous shock and family sort of claims as well.
Okay. And then you just you mentioned that in your submission, I think, and your annual report or your report, that the tort temperature across the nation is moderate, with the exception of Victoria, where significant awards have been made for historical abuse claims. So can you just explain a little bit more what underpins that analysis or that statement?
Yeah, so our assessment of tort temperature is something that we've put together to help the market sort of understand the sort of level of awards and the sort of claims cost increases that they might expect. It's very judgmental in nature, our assessment, and what we put in this report. We do look to look to take information from the advice and the analysis that we see, and also to look at sort of court awards and judgments as well, and assess whether they're sort of awarding defendants or going in favour of defendants or plaintiffs. So it's very judgmental in nature, that tort temperature being moderate. As you say, we call out Victoria, and that's that's sort of underpinned by looking at information and awards coming from the decisions coming from the Victorian courts, and also from broader sort of advice that we provide.
And what sort of decisions? Because you mentioned historical abuse claims. So what are these historical abuse claims that have emerged in Victoria that have increased those claims?
Mostly in regards to child abuse. Yes.
Okay.
Yeah.
So it's people being awarded for things.
Mental harm.
Mental harm and damage.
Compensation around the sort of loss of earnings or medical supports that they need in that regard.
Okay. And then when you say just the tort temperature across the nation is moderate, does that mean that claims are not rising significantly or out of step with historical averages? I mean, is it just sort of, does that mean it's business as usual? It's not a concern, or what?
Yeah.
What does that mean?
Yeah, what does it mean? So if I go back to at an industry level, if we look at the liability claims trends and look at how the average claim size is increasing, a moderate level would be sort of a couple of percentage points above economic inflation, as opposed to what we might have seen previously before the previous reform, which were, if you look at the statistics from that period, it was a much higher increase.
Before which reform? Sorry, which reform?
The reform in 2000, so the major sort of civil liability reform.
Okay, the one from 2000 though. There hasn't been anything done of significance.
Nothing
since then,
substantial
right?
since then. Yeah.
Okay.
Can I just ask a clarifying question there? Can you put some numbers around, that expansion that you were talking about? Yeah, so some more detail.
We can come back on that, yes, and we'll use the APRA data to come back on that.
Thank you very much. Back to you, Senator Sharma.
That was all I had, Chair. Thank you.
Okay, thank you. Ms Lawrence.
Thank you. I'd just like to understand a little bit more around exclusions and the extent to which you capture data on policies that exclude certain acts. Is that something you capture at all across the different insurance classes?
Can I just clarify, was that certain acts? Is that what you, just to clarify?
So because you've identified particular categories where it's hard for certain sectors, scaffolding, some, I think you mentioned about the church groups, accessing insurance. So I'm just wondering, are they having to acquire policies that have exclusions to lower risk to the insurer?
Sure. We don't have any information, and there's no publicly available information we're aware of on that. So the question around the individual businesses' responses is probably directed better at them, at the businesses themselves and in what they've had to do.
And what about, do you collect any data on the extent to which you're seeing self-insurance rise?
Yeah, there's no publicly available information on self-insurance. The macro level data that we get is premiums that are insured, and so by definition we don't know what's not insured or self-insured rather.
What about any data that you might have on sectors that used to be hard to insure in terms of affordable premiums and for particular classes that are now no longer in the marketplace? So are you seeing any trends from over, a period of time? For example, motorcycling events, I think my understanding is they do self-insure. So presumably at some point there was a market for insurance coverage in the public domain, and then it's changed over time, and now that's not a sector that's on your list because they self-insure. Like, is there any trends that we can see of sectors that have disappeared from the market offering?
Yeah, because the industry data is at a macro level and it doesn't go down to sector, we can't see in that data whether there's been industries that have come in and out of the insured market, because the data's not at that sector level.
It's a question that could be asked to APRA, who do collect information on liability data.
Okay, great. Thank you. Yeah, I just don't want us to have a blind spot to only looking at where perhaps insurance premiums are becoming, difficult to source or becoming unaffordable, but are blind to the number of sectors or industries and businesses that have suffered from the same fate some years back and now have had to find an alternative workaround, which may be less optimal.
We've noted some anecdotal segments in our report that I think have also come out in the discussion as well, but publicly available data isn't a source that we have to access on that.
And in your submission, you just talk about the rise with cyber insurance. Are you able just to explain what people are looking to insure against for that particular product?
Sure. So cyber insurance product covers a combination of first-party and third-party claims. So first-party would be in terms of the response costs if they have a cyber incident. It might cover rectification, investigation, sort of cyber security services. It can also cover if there are sort of fines in response to that, and also business interruption on account of a cyber incident. That's the first party. They can also cover the third party, which is if they are if there is a claim made against them for the cyber incident that they received from a third party that they're being claimed against negligence for them. So that would be the liability cost that would be covered for them. So it's a combination of first party and third party cover.
And from the statistics of cyber breaches, it looks like it's a potential growth area of the market, but I think your report is suggesting the premiums at this stage at least are fairly stable. Is this the case? Am I interpreting that correctly?
What we're seeing is there's statistics that we report that show that there's an increase in the number of incidents that are occurring across the board, including SME businesses. So that is correct. The insurance premiums have stable. They've actually been reducing in the last couple of years. That we do note the numbers in our report. So yeah, what you said is correct.
And so would it be, I'm just trying to understand a little bit like how the prices, the premiums are coming down or stable or coming down, but there's a growth in the number of breaches. What's underpinning that decline in the premium? Is it just the size of the market pool is growing it to like offset the increase in the number of breaches, or is there no correlation to breaches and claims?
There's certainly a correlation. One thing that I would call out here that would be occurring in the market is that market cycle that occurs when additional capacity and competitors come into the market, and that creates competition. And what we're observing here is that market cycle, and this is correlated with an increase in competitors coming into the market, and therefore that sort of has linked to, I would link it to a reduction in the premiums. So there are sort of a few factors at play that happen in the market. There are claims costs, and then there's also that competition that does sort of lead to the market cycle, the soft and hard market cycle that you mentioned earlier.
And would you have a sense, or have you got the data as to how many competitors there are in terms of offering this product, just so we can get a sense of comparison to other sectors where perhaps there is less competition to drive a stronger premium mix?
Yes, I can take that one on notice. I don't have the number in my mind, but we can provide that to you.
Thanks, Chair.
Thank you very much, Ms Lawrence. I'll give the call now to Ms Jarrett.
Thank you. Good morning. I was looking with interest at your at the chart that you provided on the liability, the changes in rates of liability insurance. I just want to check what is what does liability cover here? Is it public liability, product liability, professional indemnity? Is it across the board? What is that?
Liability in our publication covers public and product liability.
Public and product only.
Professional indemnity is separate, so it's not within here.
Okay, and I see that there was quite a substantial increase in premium rates 2019 to 2020, and then another big jump 2021, 2022. What was the driver of that? I think I might know the answer, but what was the driver of those increases?
Yeah. It would be the response to claims costs. So
associated with the pandemic, or
no wider liability claims cost pressures. So if you
interest, okay.
Yeah,
so do you know what's behind that liability claims cost pressure increase?
So if you look down at the bottom combined operating ratio chart, you can sort of see
you'll have to go a couple of pages back from where you are. So
Right,
Page
yeah.
are we talking about?
so on our page, it's on the bottom of our pages. It's 94.
Yeah, I don't have that one on me, but
Yeah. So it's probably a couple of pages back from that premium rate chart.
right. Okay, here we go. Okay, so what's behind that data?
what's behind it.
Yeah,
So
that's what we're
you
trying to
can,
understand. Why the increase, and then I'm going to ask why the decrease.
why the decrease?
Yeah,
So
yeah.
the increase was linked to poor profitability coming through, which you can see in insurance trading results, sort of those blue negative bars. That was sort of increase or sort of strengthening or increase in claims costs, basically driving that.
But do you know what the underlying data is? Why those like what was driving those claims costs? Was there an industry? Was there just a change in like all of a sudden the courts decided to award bigger claims?
The detail, the informational statistics available are at a holistic level. There are some of the areas that we have called out in our publication are cited as the reasons behind that. So if we look at those, worker to worker, historical abuse,
Yeah.
silicosis as the areas that were cited as some of the key contributors to that, but we don't have any facts or statistics to attribute.
And do you have a sense, or can you get the data that indicates like which size businesses were predominantly impacted? Was it more the larger businesses or small, medium? Do you collect that data? Can you get that data?
That is information that is a question for APRA. They do collect that information.
Okay.
NCPD, National Claims Policy Database, is collected from Australian APRA authorised insurers.
Okay. Okay. We'll try and put some questions to them, but if there's anything that you've got that could give us a better indication of the drivers of the increases and the decreases. I understand the decrease might be, from what you said earlier, increased competition. Is that correct? Okay.
That's right, yeah.
Okay. Just on the cyber, I just wanted to pick up on the discussion we just had with Ms Lawrence. If my understanding is that the cyber insurance premium pool remains small, and I think that was in your data. If you're projecting out where we are going as a nation in terms of the use of technology, the use of AI and all of that, have you done any predictions as to what that growth might be, should be, and where the insurance market may go in response to that?
That's something I can take on notice.
Okay.
And there are some sort of figures that you can point to in terms of the size of the property and liability market is sort of a good base to refer to.
That would be helpful if you could take that on notice. Thank you.
I would just call out the product take-up is another component as well as the underlying risk. So the actual take-up of the insurance product by
So more people are purchasing.
more people purchasing is part of what increases the pool, as well as sort of the underlying technology and sort of risk of technology over time.
Yeah. Thank you.
Wonderful. If I can just take you to page 96 of your submission. You make some comments there about labour hire. Could you just flesh out what's happening in that space, please?
Sure.
It's under the heading worker injury claims.
Yes. Okay, got you. So labour hire here is talking about where particular industries can have a workforce that is sort of through contractors or through a company that provides employees or skilled individuals, and that's sort of what we're talking about in this regard. That labour hire workforce they'll be employed by a labour hire company. So there'll be lots of individuals employed by that company, and then they will be sort of engaged in work with other companies, often in areas such as construction, hospitality, those types of industries. So in those areas, those individuals can actually, if they injure themselves, that can lead to a claim that is made against public liability.
A claim against, sorry?
The public liability policy, even though it's an individual engaged in a workplace and during the course of their work.
Okay, so your comment there is really about how the data isn't captured under workplace injury, but captured under public liability.
The claim is, yes.
Correct. Okay.
And as more companies are using that sort of form of employees, that increases the claims that will go into public liability.
Okay. So often labour hire has been exploited, because it's not always a bad practice, but it has been exploited as a cost-saving measure, and we've ended up with people doing the same job but at very, very different rates of pay. It concerns me in your submission that you write here, in addition to what you've described as the distortion in the public liability space, which is not going to capture adequately that it's a worker injury problem, you assert that the use of labour hire has been growing as a proportion of total workforce, and trade shortages are potentially leading to higher worker-to-worker exposures. What do you mean by that?
Worker-to-worker is a term that the insurance industry uses. It's probably not well suited to what it actually means. It actually means it's a worker, an employee that has been injured during the course of work, rather than it being, if I'm understanding your question correctly, it's not sort of to do with worker injuring another worker. Was that the question?
Yeah, so I understand what the term means now.
Yeah.
You go on to say where insurers can adequately capture this increased exposure and rate on it, premiums will increase commensurately. However, if worker-to-worker claims arise from policies that don't declare this exposure, then there is a risk of inadequate pricing. How much could labour hire use impact on pricing of these policies?
Can take that on notice.
Yeah, that's one we can take on notice in terms of coming back with some statistics around that.
It is fair to say, though, that the source of claim, these worker-to-worker source of claims, have been a driver of the increase in claims cost for the liability segment over the last few years.
Okay.
So if we go back to
How efficient or inefficient is this shift in the market? Because it's like there's another growth industry, really, isn't it?
what we can say is that under the tort reform, the civil liability reform, the amounts that are awarded for those injuries are typically more than what is awarded under the workers' compensation schemes.
And is that an artefact of the market or the legislative frame?
That one's hard to answer. It's probably an opinion that will probably stick to the facts here.
Okay.
We can take that one on notice and
Yeah, have a think about it.
Have a think,
Just to help
yeah.
me understand a little bit more about what's going on there. Because one of the things that concerns me is ambiguous cost shifting that benefits particularly individual businesses, or in this case perhaps individual sectors. The construction sector was like, let me just sheet every other responsibility. I'm actually employing somebody, but I'm going to construct it in such a way that it looks like I'm getting a contractor and I'm not going to have to pay workers' compensation, so there's a cost reduction for my business, etc. So individuals who are doing that actually are impacting others in the sector who are operating within the perhaps that's not legal, but illegal, but they're operating within the spirit and the purpose of the law and in the community benefit and transparently in terms of insurance, whereas this is kind of like a little dark hole, unobserved space, which looks a bit like cost shifting to me, and an area that doesn't appear to be covered by tort law as it was designed early in the 2000s. Mm-hmm. So if you could help me understand that space a little more, can I just express some concern about what might be operating there and the scale of the problem that might not be observed. Do you know if APRA would have any data on that?
they would have some data on trends in this worker injury or worker-to-worker space.
Okay, so we might need to follow up with APRA, see if we can get some more information from them with regard to that as well. If I can take you back to also page 95, market hotspots, worker-to-worker, you've given an explanation. What are the US exposures?
What we've pointed out here is in Australia we do observe that the court trends and judgments that occur in the US can sort of carry across to Australia, and similar types of decisions and actions can occur in Australia, and that's sort of what we're calling out here.
Is that kind of innovative practice of litigation firms based on what they observe in the US? Is that a shorthand version of what you're saying to me?
Yes, that's right. And I guess actually here, sorry, let me correct myself. Here I think we're saying if anyone has exposure to the US, that is a business in Australia.
Okay.
Sorry, I need to correct myself because I've just realised it's if a business has exposure to the US, they are seen as a high risk environment because of the nature of the settlements that are seen in that jurisdiction.
Okay. So there are a number of companies that are seeking to establish themselves in the US. That looks like it could be a growth area as our relations with the US, given the political realities, increase. So there is risk embedded in that sector that's a little unclear, or there's rising costs that could be associated with that.
The segment here was, we were highlighting it as an area that is harder to place. So seen by the market as higher risk areas, and they may have more challenges getting insurance.
Okay. PFAS, you've mentioned. Music venues, we've got a lot of evidence from music venues. Do you have anything further that you can add, other than it's just difficult to find out what's going on?
That's one, in terms of segments, again,
Yep.
that's something that APRA may be able to help with in terms of data.
Okay. Can I go to parks and active recreation? Same problem?
Same, yeah.
All of these to APRA, religious and educational?
Yeah, these are all segments that we understand from our work in the industry have challenges in getting cover, but unfortunately there's no data, publicly available data, to validate the extent of the issue.
Okay. How critical is it that such data is actually available to the market and transparent to those who seek to observe, perhaps yourselves? And why is it so difficult?
Yeah, I think the question on how much data should be available is probably one placed to APRA as they govern that data. As actuaries, we like data, so obviously the more data we have, the better, because we can analyse it and form views. But the question about what is appropriate data to share, given constraints on confidentiality, is one to pose to APRA.
Okay, so I'm just putting myself in the shoes of a small business person. I'm dealing with, somebody can't attend work today. I've got a lot of things going on. In the back of my mind, I know that an actuary is really good at maths, and they do all these calculations, and they're looking after things and making sure the information in the sector is pricing that's sustainable, but also they're mindful of a balance in the market as you provide advice. That's how I think most people think about what you do. However, since your submission, there's a lot changed in the world. We are in an incredibly unstable period in terms of business. How may that have altered the assumptions that are embedded in your submission as it stands, appropriate as it was for the moment of submission? What are your thoughts about what's live right now?
It's hard to give any hard figures on how our numbers might change, where the numbers that we present here are very much looking at what's happened in the past.
Yep.
And drawing conclusions on that. So
the retrospective, not prospective.
That's right. But the obviously what's happening in the world geopolitically increases uncertainty, and insurance is there to deal with risk and uncertainty. And so it's the global issues that are occurring now, geopolitical risk and also the inflationary environment, would be things that we would expect insurers to be thinking about when they're thinking about their how to deal with the impacts of claims cost next year and the year after.
We can talk to some of the trends that if inflations are increasing and costs of goods and supply are increasing, that does flow through to claims costs. So that's something that insurers will be thinking about. But then, it's such an uncertain environment that it's quite hard to put any specific figures on it.
We all like certainty, but life is very messy, and perhaps it's a little messier in the insurance industry right now than it has been for some time. If I could go just to the scaffolding industry, just as one example that you said it's difficult to price. When you provide your information as actuaries to insurance companies, are reactions? Are there possible reactions like, okay, well, let's just have a look at scaffolding. Well, that's way too dangerous. We're just going to stop providing product. Does that happen?
Can't really comment on work we do with our clients. Primarily what we do is look at the data and analyse that data from a technical perspective, and then the insurance companies then decide how to use that information to form their view on how to go to market.
So you're not responsible for their decisions, but you put the information to them. Is it possible that they could use your information and go, okay, well, hey, we've got some red flags here. Well, trade contracting, very problematic. We're just going to stop providing a product into that market. We'll leave it. We'll pull out of that. Parks and active recreation, not happy with the risk there. We're just going to pull out based on what the actuary gives them. Could that happen?
I think it's a question for the insurer. Yeah, I think it's a question to the. I don't think we're well placed to answer what insurers would do with that information.
Okay. All right, that's very interesting and helpful. Thank you very much. Can I thank you for taking time to give evidence today? You have indicated that you will provide a few answers on notice. If you could do that for the Secretariat before Friday the 29th of May, that would be very much appreciated. And because this is an initial hearing in the inquiry, we might recall you or ask for further information. We'd appreciate any assistance you can give us in getting the shape and form of this. The other thing is, if you've had a chance to look at any of the other submissions or hear any of the evidence and you think there's additional information that would assist the committee, we would be very welcome to receiving that from you. Wonderful. Thank you very much. And I now welcome Mr. Colin Jennings from the MTA Group. Good morning, Mr. Jennings.
Good morning.
I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full name and the capacity in which you appear today?
Yes, my name is Colin Jennings. I'm the Head of Government Relations and Advocacy for the MTA Group.
And that stands for?
So it's the Motor Traders Association Group. We are made up of Motor Traders Association of New South Wales and the Motor Trades Association of the ACT.
Thank you very much. You see the members and senators here before you, but we also have Ms Tanya Lawrence joining us by teleconference from Western Australia. For the Hansard record, will you please state your full name? Oh, sorry. I now invite you to make a short opening statement, and at the conclusion of any remarks, I'll invite members of the committee to ask questions.
Thank you very much. As I noted earlier, I'm here in the capacity of the MTA Group, MTA Group being MTA New South Wales and MTA ACT. For over 115 years, MTA New South Wales, and for over 50 years, MTA ACT has been the representative voice of the motor industry in those jurisdictions. We represent over 3,200 businesses, employing over 35,000 workers across the jurisdictions. It's essential, we believe, for the committee to recognise that the automotive industry is not a monolith of corporate giants. It's actually built on the backs of small and family-run enterprises. In fact, 90% of our industry are small businesses with less than 20 employees. In fact, the majority of those will be less than 15 employees. These are workshops in quiet suburbs and essential service hubs in small country towns. For these operators, insurance is not just a ledger entry, it is their licence to trade and the protector of their families' livelihoods. Across the national landscape, automotive and small business premiums have been escalating at an average of up to 60% since about 2020, a rate that vastly outpaced both revenue growth and general inflation. And in specialised sectors like independent towing and heavy vehicle recovery, we are witnessing some withdrawal of insurer appetite, leaving essential service providers with no viable options for cover. This financial pressure is compounded by the rising costs of workers' compensation. In our jurisdictions, we have seen significant increases in premiums driven by the rising cost of claims and a complex regulatory environment. For a small business owner, these mandatory insurance costs, combined with escalating public liability and business interruption premiums, are becoming a prohibitive barrier to employing the next generation of apprentices. When insurance becomes a deterrent to hiring, the long-term skills pipeline of our industry is directly at risk. Central to the sustainability of our industry is our commitment to technical excellence. Our members are currently leading the transition to new vehicle technologies, including electric and hybrid systems, by investing heavily in specialised tooling and accredited training. However, there is a profound gap emerging. Despite this rigorous upskilling to manage high voltage risks safely, insurers are failing to recognise these professional standards with premium reductions. The MTA Group maintains that lifting industry standards through continuous training is more crucial now than ever before. Any move to lower or dilute these professional standards to find short-term cost savings or vertical integration models creates a significant long-term risk for consumers and workers and business owners. We believe that professional training should be a primary lever for risk mitigation, yet currently a workshop that invests heavily in safety and high voltage training is often priced identically to the one that does not. MTA Group advocates for a fair and stable insurance landscape that accurately reflects the modern automotive market. We believe there is an urgent need for greater transparency to ensure the premiums are based on data that recognises the professional reality of our trade. Are members of the lifeblood of their communities and the mentors to our future workforce, and they need an environment that supports their longevity. And I welcome any questions from the committee.
Thank you very much. Have we got any questions from anyone here?
Not for me.
Yes,
Yeah, Mr. Buckle.
Thank you, Mr. Jennings, and thank you for your opening comments, which you offered a couple of paragraphs about the significance of training. And can you just help me tie the significance of training to your insurance costs?
I think I can. If we look at emerging technologies, such as electric vehicle, which is one, which we're definitely seeing taking off across the country. I think yesterday FCII's figures were about 16%, and certainly significant increases in electric vehicles. A lot of those vehicles are now coming to the end of their warranty period, and therefore will be entering the independent workshops, and the small business workshops, as those warranties expire. Now, electric vehicles are a different vehicle to an internal combustion vehicle and require different training, which is why there is an apprenticeship in electric vehicle technology, 32721. But for the existing worker, for the existing technician, there is upskilling available through a 3-day skill set if they wish to diagnose, service and repair that vehicle. And because electric vehicles pose different risks, they require different training. So that training model is important because it should be a reflection into the premiums because you're lowering risk. In New South Wales, we have a licensing scheme which reflects the training model. So each class of vehicle is under a licence. So a light vehicle technician, someone who works on a standard car, is licensed in that class. Heavy vehicle, the same. Auto electricians, the same. For electric vehicles, that class doesn't yet exist, even though there has been commitment by the New South Wales government to introduce that licence class, and we have advocated for that licence class. That would therefore allow for a skilled technician to do 3 days training and then legally undertake that service and repair. So it's an upskilling requirement. So that technician becomes competent to work on that electric vehicle by doing a 3-day skill set, or if they're a panel beater, a 1-day safety course. That training therefore means that they are safe and competent to work on that new technology.
Yeah.
And that should be reflective in that, because they are skilled at that level to undertake and therefore mitigate that workplace risk. And so seeing that take place has been our absolute driving force over the past few years, is to highlight the fact that there is training available, that should be training, it's upskilling, it makes people safe. We have already seen an incident in Victoria where someone who wasn't trained on an electric vehicle had an incident.
Just elaborate on that.
There was an incident in Victoria where a technician approached an electric vehicle to do some repair work. They weren't fully trained, therefore they picked up the wrong face shield. They therefore engaged the battery, and the battery, what is called, arc flashed, and there was damage to the eyesight. Now, fortunately, that person recovered from that. But for that business, that's a workers' compensation claim. If that person had been trained, there is less risk that that would occur.
Are you arguing that the insurance bodies don't see the difference between someone who's trained and someone?
I will say this, the biggest advocates against licensing for EVs in New South Wales is the Insurance Council of Australia.
Say that again?
The biggest advocate against introducing an electric vehicle licensing class in New South Wales is the Insurance Council of Australia.
What do you think? And I know you don't speak on that, but you, as an industry body, do you have a perception as to why?
There is a general overall position on licensing in the trade. The overarching statement is it's labour mobility. That's the standard answer. If you have a difference because New South Wales is licensed but Victoria isn't, it reduces labour mobility. We don't particularly see that, and nor do we agree with that.
It's a break to keep everybody at the same low level. Is that what you're saying?
Yeah, there is a. We wouldn't say that. We wouldn't speak totally on it, but a lot of the submissions that we have seen from the Insurance Council and some other players in the industry are that licensing is a brake on labour mobility and therefore an inhibitor for businesses. We don't see that within our own fields. We see people move. There is a very easy, or a much easier mechanism to gain a licence in New South Wales as someone who's qualified from another state. The process of that is to present the qualification, because it's an AUR qualification, an ASQA qualification, to present that qualification to Fair Trading New South Wales, and a licence is issued. If it's interstate, we worked with Fair Trading ourselves to bring that wait time down from 60 days to less than 14 days. So in terms of mobility, without an automatic mutual recognition scheme currently in place, because there is no licence except for Western Australia, that is a pretty good outcome in terms of turnaround times. It would be better if there was national licensing, but in the turnaround time of less than 2 weeks to gain a licence to work in New South Wales, that's a pretty good outcome. So the thing that we believe with licensing is it helps to raise the standard, because you have a benchmark, which is an ASQA approved certificate, either a certificate 3 or in this case a skill set, which is derived out of the apprenticeship, that lifts the level, provides better safety for the worker and for the owner, and should be reflected in premiums with insurers, because those skill sets are necessary.
Has the industry MTA raised these concerns with the Insurance Council?
Yes.
What and their response?
Well, in that we've raised them through the forums in New South Wales, and they certainly are aware of our issue, because it's been our issue with licensing since licensing came into effect certainly under the dual melded Act, which is the Motor Dealers and Repairers Act, which came into place in 2013, but even before then. So the MTA New South Wales has been front and centre in ensuring that those standards are maintained through a licensing regime.
So you're arguing that if you train your mechanics on EVs to a higher standard, where at a minimum they know how to isolate a current flow on an electric vehicle, that the amount of accidents should be dramatically reduced. As a result, you're then in turn looking for reduced premiums because of the reduced risk.
That would be the hope
That would be the hope.
Yeah.
And this has not been favourably looked upon by the insurance because, well, I can ask them the rest of the question, but they're not looking favourably upon that.
They're certainly resistant to, as we say, the licensing framework, which would, embed that safety requirement in New South Wales.
You also mentioned in your opening comments about that premiums contribution on how the insurance is made up. Can you just go back and speak to a little bit about how the premium makeup in the context that you spoke about in your opening comments? In
regards to things like workers' compensation. And general insurance covers a lot of
because
that.
One of your submitters in submission 34 found that the price of insurance has almost become unaffordable. We use half of our yearly profit just to pay out insurance premiums. We're looking to remove cover to make it more affordable.
Yeah, that's a direct quote from one of our members. And that is the multifaceted layer of insurance. So areas like workers' compensation. Then you have general insurance. The makeup is the general insurance, public liability. You can have recall insurance for certain elements. So those are the makeup of it. And the issue for the small businesses, and if we're looking at small business and small business insurance, it's really important to understand that those small businesses, so the small business with the owner and 3 employees, is trying to navigate 1,000 pages of legislation. And with no human resources department, they're trying to navigate those pieces of legislation, new parts of that legislation that they need to understand.
But that's why they're a member of your association.
Which
so
is
they
why,
get
partially, yes, and we can help them navigate. Some of them that aren't members of our association, therefore will require, hiring of legal experts to navigate that, which is an additional cost. We do provide that as a not-for-profit organisation. Part of our service is exactly that. We have an employment relations division, which helps businesses navigate through employment issues, which can include insurance, and we try to explain to our members and to the industry as a whole what the impacts of that may be. So if we take, psychological injury, which is now a new component upon that, what does that actually mean for that small business? Yes, as members, they can come to us and we will try and explain it. If they're not members of ours, then they have to navigate that. So those complexities add to the cost. And any ongoing cost, and insurance is probably number 3 on the costs of small businesses after, wages. And consistently, you can see in any survey, our surveys, Chamber of Commerce surveys, sentiment surveys out of small business commissioners, the cost of doing business and the cost of insurance is a consistent burden for small businesses.
Thank you, Chair.
Thank you. Can I just put it to you, witnesses we had before you came to give us evidence, Finity Consultancy, they generally seem to indicate that things are stabilising and some costs are decreasing, yet that is completely at odds with the evidence that your members are reporting to you and that you're reporting to us.
I didn't hear the full evidence, nor have I read that submission. That may be overarching for lots of areas, but it would be slightly contradictory to what our members are telling us. And you would probably, I would imagine, see the same sort of indications from other associations in the sphere beyond ourselves, that those costs are rising in the automotive sector.
There's a few sectors that were described as market hotspots by the previous witnesses. Trade contracting was one of the areas. I don't know that that's going to cover you guys, but you're not mentioned as a market hotspot. One of the things that concerns me is that in those hotspots that they've declared, there's the potential for withdrawal of insurance by the insurance providers. They just go too hard, withdrawal of product. What's happening in your sector as you indicate people thinking about not paying for any insurance?
Yeah, because of its cost. In a couple of things, I'm not overly. I would say that we are not overly surprised that automotive isn't noted, mainly because if you look at ABS data, automotive doesn't exist.
Yeah.
Okay,
Only 35,000 people. Why should we pay attention to that sector?
Well, yeah, nationally the workforce is about 320,000.
Yes.
Contributing, $18 billion to the national economy. We represent 35,000 employees. The actual workforce is probably more around about sort of 70,000. We're a third of the workforce in Australia, and automotive contributes about $4 billion to the state economy every year. But because it's a diverse group, it takes in retail, it takes in other areas. ABS data doesn't reflect automotive. It will reflect construction, but it doesn't reflect automotive. So if those people are looking at ABS data sets, they won't pick that up. So it's not necessarily surprising to me, because it's sometimes hard for us to extrapolate data because we're not singled out in those metrics. But what we are seeing and what we have seen, and this would be reflective with other groups that may present evidence to you from our sector, is yes, in some areas there is a complete retraction or near complete retraction of insurance products in niche groups. And when I say niche groups, I'm talking independent tow truck operators who we represent.
So just talk me through that. So that they once upon a time had insurance, and as you indicate very clearly, insurance provides financial security against unexpected losses, helping business manage risks that could otherwise be financially devastating. So let's go to our tow truck operators. They set up their business. They might not know a whole lot, but they know that they've got to get some insurance. They go and get a range of insurances bundled together.
Yes.
Perhaps directly, maybe through a broker. Which one would they have?
Most small businesses will use a broker.
Okay, so
That's
they've gone to a broker.
in us and other associations. So most people will use a broker and yes, bundle up their insurance.
Right, so I need a bit of maybe cyber insurance now. I need some workers' comp sorted, but I've got specific things according to my state. I want a bit of business insurance. So they'll get a package. What's been happening with the tow truck sector to get to the point where you've just described that there might not be any insurance available to them?
Yeah, it's mainly in the regional areas, and some of that comes with risk of damage to vehicles. Those tow trucks are not cheap. You're talking, $250,000 minimum for.
Why is it more risky for them in regional areas?
It can be because of the environment in which they're operating. It can be the types of vehicles that they're towing. There are a number of factors involved in it. I'm quite happy to take that on notice and give you some more precise information.
Yeah, great. So assuming there's a range of factors involved, once upon a time, tow truck operator can get insurance through a broker at affordable premium. Now where we are, where you're saying to this committee that there may not be an insurance option available for tow truck drivers, even with a broker. How do we get there? What's the problem?
It is a niche area. It is to do with, in many instances, unlicensed operators working in the space. It can be
Unlicensed operators.
Yeah, unlicensed or what the industry calls rogue operators. There's a lot of competitiveness within that market that can lead to accidents. And once you have one accident, so if a truck runs into another truck, then that's a premium hike. And if these operators are working on very small margins, really small margins, and those increase.
Not 10 to 15%, I'm assuming.
No, but over time.
Which is the figure we heard about, expectation for insurance,
Yeah.
10 to 15%.
And it will get to that point over time. Insurers requiring more from the operator, which they may not have. So if the bundle, and you mentioned cybersecurity, if that's put into a bundle and a tow truck operator doesn't use cyber, then they're paying for a product that they may not use. Injuries occur in tow truck operators. They can slip, they can, fall, they can strain themselves in moving vehicles. Even though they're electronic, they're still moving heavy vehicles. Those incidents will require them to make claims, and if they make claims, then their premiums go up. It's the ongoing cycle.
Okay.
Can I just...
Please, Mr.
Sorry,
Buchholz,
yours connected
and then I'll
to
come
this?
to Ms. Jarrett. Yep.
Is yours connected to this one, Senator?
Yes.
Yeah, so you go.
I was just going to ask though, with the bundling, with your members, do you see that the way the brokers and therefore the insurance companies who provide, are they giving sufficient choice to your members in terms of what can be bundled and what cannot be bundled, or is what we're seeing coming from the insurers strict? Here's your bundle. Take it or leave it. Yeah.
There is some take it and leave it.
There is. And is that more in the high risk area necessarily, or just you think generally across the board?
I think it's generally across the board.
Okay.
But again, I'll take that on notice and provide you with
Yeah,
that.
thank you.
Bundling and using brokers assists with that. But in some of the higher risk areas of our industry, then it certainly becomes incredibly hard. And I've got a member in a regional area whose insurance premiums have gone up nearly $5,000 to $10,000 in less than 5 years.
Yeah.
So
as a proportion, is that like a 10%, 20%, 30% increase?
that's most of our members are, when they record increases, it's over 30%.
One more question from Ms. Jarrett, then you, Mr. Buchholz.
And when the insurers look at the bundling and putting together the products for your sector, is it the motoring sector, or are you part of a broader pool, or you don't know?
I would take that on notice.
Yeah.
It feeds into the line of questioning that the senators. You said earlier on that you conduct surveys when you communicate with your members. Is there anything revealing itself from your surveys that makes you think, or is there any evidence to suggest that your members are underinsuring as a result of the increased premiums? And if so, is there any indicative evidence that you can share with us?
Feedback that we've got is either some members are underinsuring or are very seriously considering underinsuring, and direct conversations are, it's too much, so I'm going to pull back on some of my insurance.
So which areas are they doing that? Because you can't do that with workers' comp, and there's a couple of them.
No, you can't do that with workers' comp.
Just break it down for me.
So they may be trying to minimise some of their business insurance costs. Where
they had it valued, the shed valued for X, it'll be X minus 50%, or
correct.
Yep.
And so that sort of property insurance
Yep.
is a very good example if they own the building.
Yep.
It's a
So if they're bought,
cost-saving move.
it's a cost-saving move, mind you. If
There's a risk.
if the building burns down, then
There's
or
minimum
exploded.
public liability that they can't walk back from, so they're pinned there.
Yes.
So there's very few places where you can underinsure.
Yeah, or they remove that insurance in those areas that are not.
And not have public liability.
If they see it, and as is noted here, direct quote from one of our members, we're looking at how if they are paying half their profit or more than half of their profits, which isn't large, these aren't large corporate entities, into paying their premiums, then they're looking at how do I pull those back? In what areas can I pull those back?
Yeah.
And we are seeing that in our sector. And I would say that, if you get anyone else into this room, they'll probably tell you the same thing.
I have a local mechanic in my town who's at complete despair. Mechanic, 2 or 3 apprentices. His net profit last year was $11,000. And he said, years ago his quality of life used to be quite comfortable. Now he questions why he's in the industry.
And that is an example across the board and across the country. And we especially see that in regional parts of the country.
I'm a regional member.
Regional parts of this country really struggle with insurance for their businesses for more than metro areas because of a raft of issues. So if you are a business up in Lismore and Lismore floods again, then there is a real risk, and we do see that withdrawal in the regional areas, which makes it more difficult for consumers and motorists, because if you are in a small town and that one mechanic or that one body repair shop or that one auto electrician leaves, then you have to go to the next town. And so that has a direct impact on the consumer, that has a direct impact on the community. And especially when you get into regional areas where agricultural machinery and the requirements of the mechanics and repairers in that sector comes into play as well. So it's across the board. So that one example we hear consistently.
Thank you, Chair.
Thank you. Mr. Jennings, in your submission at page 6, you indicate that contracting insurance market has resulted in fewer underwriters willing to cover automotive repairs in Australia, and you assert that it's created a market distortion where a handful of large internationally listed conglomerates exert significant influence over thousands of localised small businesses. Which are the internationally listed conglomerates?
It would be probably A-listed. Sorry,
Okay.
Slight typo there, but yeah, when you've got Allianz, which is based overseas, that would be the one, and we are reduced down to
So are you talking about one provider of insurance into the entire market in Australia?
to one that is internationally based. I'll provide the details on that on notice, but the insurance space in automotive is reduced down to 3 players.
Okay, and
So,
can you name them?
so that would be IAG, Suncorp, and Allianz.
Okay, and if I could, which specific insurance classes in the automotive sector are experiencing the greatest withdrawal of underwriters? Is it workers' comp? Is it professional indemnity, property, or cyber?
I will take that on notice.
Okay. If I can go to your submission recommendation of a harmonisation of federal and state regulations and taxes, could you give me some detail on the points of friction and added costs in insurance and administration? And I note that you've got some commentary about border-based businesses as well.
And that's really where, you know, a harmonisation would be beneficial, is for those border areas. I think we give an example in the submission of clashes and friction in workers' comp between, say, the ACT and New South Wales, with journeyman, what's called journeyman insurance, where the worker is protected under workers' comp going to and coming from work. That's a more stringent regime in the ACT than it is in New South Wales, and so there's a friction. If it's harmonised, if you get harmonisation, then you get less of that distortion between the two. So the ACT and New South Wales is a good example. So if you're a small business based in Fishwick,
Yeah, or Queanbeyan.
and then you want to go to Queanbeyan, then you've got that, you know, and you're only talking 10, 15-minute drive. Then there's that issue of differences in workers' comp, and what does that mean, and how does that affect your claim if you're protecting over that? So, the complexity is a major issue for business overall in trying to navigate things like workers' comp, public liability, the requirements in each state and territory, levelling those out and getting a more consistent flow would certainly help small businesses at least navigate those complexities. And if they can navigate those complexities, then they're on a better footing to negotiate with their insurers on what insurance cover they get.
Thank you. The MTA, do you represent franchises?
We have some franchisors as members.
Okay. So are their obligations the same or different from independent SME?
I believe there's some differences. I will take that on notice. We don't have a lot of franchisors as members.
Okay.
And some of them operate slightly different models.
So there might be franchisors who have a collective package, but there might be some franchisors who say, no, you source your own, depending on the franchise model. So
Correct,
if you could,
depending on the franchise model.
if you could give a bit of shape and form to that in your response, that would be really, really good.
Certainly.
I note that you have some concerns about consumers making unjustified claims against dealerships with regard to consumer law. I know from my engagement with the automotive sector that there's a lot of tension and pressure between the OEMs, their professional responsibilities or ethical responsibilities for the product they provide, and where that interfaces with automotive dealers. Could you explain a little more about the impact of complaints paid to consumers?
Yes. So this is complexity between state requirements and the Australian consumer law.
Yep.
If we take an example, so the Australian consumer law doesn't note fair wear and tear. So if we use a new car dealership may receive a complaint against the vehicle It could be a change of mind, it could be cost of living, there may be noises that the consumer doesn't understand. Take the vehicle back to the new car dealer. Now, the new car dealer will then repair and respond, or in some instances, buy the vehicle back. If it was a second-hand vehicle, bought from a second-hand dealership, it's a second-hand vehicle. It has 20, 30, 50,000 kilometres on the clock. Consumer buys that vehicle, changes mind, it has issues with the vehicle, they bring it back to the dealership, dealership repairs, returns, and then the consumer can say, I want you to buy the vehicle back. They're under the warranty scheme in New South Wales. The way that the system works is the New South Wales warranty system, the regulations and act here in New South Wales are not reflective of the Australian consumer law. So what happens is the consumer will shop to where they'll get the best outcome. So they can make the complaint to Fair Trading in New South Wales. Fair Trading can try to resolve the issue. If they don't, but Fair Trading can say, if you don't like what we are telling you, go to the Australian consumer law. Or if you don't like the outcome that we've provided you, you can make an appeal to the appeals tribunal. But they're out of sequence, they're out of step. They don't recognise the complexity of the automotive industry.
And how is that impacting insurance premiums?
Because each complaint can become a claim. If you've got to therefore make a claim against your insurance to fix an issue, then it's a claim against you. And
okay, does it matter though whether it's come through Australian consumer law or New South Wales law?
In the insurance side, no, but it depends on the size of the claim. And if the consumer is using a stronger mechanism to get a bigger claim, then that's going to have a bigger outcome on the payout and therefore have a bigger impact on the insurance premium.
Right, so the insurers might be pricing at the higher premium.
If you have a higher premium, or if you have more complaints because you are, especially in the used car and repair sector, that's where you're going to see the mechanisms, because what is fair wear and tear? And because the law doesn't define it, it means that consumers are effectively equating a car to a toaster. And a car isn't a toaster, but the Australian consumer law doesn't recognise that.
Okay.
Doesn't recognise that someone will drive 50,000 k's through water and then return the vehicle back and say it doesn't work.
I've got a few more questions I'll put on notice, but we can have one final one. You make a recommendation that government work with automotive industry associations to develop data-driven solutions to reduce risk. Why have you made that the responsibility of government and not the responsibility of the insurers in your recommendation? They're the ones who are profiting from the risk reduction.
The recommendation is based off the work that we were doing in New South Wales.
Right.
iCare.
Okay.
So in 2019.
Yeah, which is detailed in your submission.
Yeah,
I've read it.
In our submission, and that's why it's
Directed
helpful for government to be involved in that, because those data sets, which are independent, which are driven by industry associations, the MTA group or the other MTAs, and government, then gives a better independent view of the risk factor. And
so government oversight perhaps is one thing, and reporting to governments, but the sector and the money is moving between the insurers and the business provider. Do you have any objection to insurers having to take responsibility for knowing their customers in the way banks have to know their customers, knowing their customers, understanding their businesses well enough to provide guidance around risk reduction and qualification attainment to make the sector more sustainable?
We would like to see the insurance industry be more responsive.
Is it responsive currently?
Not in the feedback that we are getting from members.
Okay. Thank you very much.
No, thank you.
Oh, Tanya, sorry. Tanya.
That's okay. No, mine was just a
Good job.
clarifying
You're
one.
paying attention.
In your submission, you noted that climate perils were a significant contributor to premiums. So I just wanted to understand if you had data on the type of perils, like is it from hail, is it floods, and what proportion of the premium, often insurers will break down what your premium risks largely consist of. So what degree is the climate perils contributing to the premiums for your sector?
Yes, thank you. That's a good question, and I will take that on notice, if I may, only because of the large, spread of businesses, and what those climate impacts are having on those businesses. So if it's in a more central to it could be drought, it could be flood, it could be hail. So if I could take that on notice, I'll try and get some detail for you.
Thank you. Thanks, Chair.
Thank you very much, Ms Lawrence. That concludes this session. The committee will suspend until 1:15 p.m. Mr Jennings, we've asked some questions. The committee will resume. I now welcome the Financial Advice Association of Australia. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full name and the capacity in which you appear today?
My name is Phil Anderson. I'm the General Manager, Policy, Advocacy and Standards at the Financial Advice Association of Australia.
Thank you. I now invite you to make a short opening statement, and at the conclusion of any remarks, I'll invite members of the committee to ask questions.
Thank you, Chair. Good afternoon, Senators and members, and thank you for the opportunity to speak on behalf of the Financial Advice Association of Australia regarding the PJC's inquiry into small business insurance. The FAAA is the largest association representing the financial advice profession in Australia, with over 10,600 members. The FAAA advocates for the interests of financial advisors and their clients across the country. Our submission to this inquiry reflects the concerns of our 10,600 members, the vast majority of whom are financial advisors. Our members are dedicated to delivering quality financial advice to Australians. Our membership is made up of financial advisors helping clients in cities, suburbs and towns across the country. We strongly believe that the provision of professional financial advice is a strong force acting in the best interests of clients. However, access to financial advice and the cost of financial advice have become big issues in recent years. Insurance, and particularly professional indemnity insurance, is a major driver of cost. The financial advice profession is under pressure, having almost halved since 2019 to a little over 15,000. It has also become highly fragmented. There are now 5,945 financial advice practices in Australia, with an average of only 2.6 advisors per practice, and the vast majority, over 96%, are privately owned. It is very much a small business sector. Financial advice practices can either have their own Australian Financial Services licence or be authorised by someone who has a licence. Those practices that are licensed by someone else need to operate under the requirements of their licensee, and this will often mean that they need to have certain types of insurance in place. Financial advice practices are typically small offices with very little capital asset requirements. Property insurance needs are relatively standard. However, those located in areas where there is exposure to extreme weather events will be impacted by the ongoing increase in insurance premiums and issues with respect to access to insurance. Our members can play an important role in assisting clients impacted by extreme weather events. This is something that they are happy to do, however, need support from government agencies to be as effective as possible. Cyber insurance is an emerging important insurance requirement where practices are increasingly expected by their licensee to have their own cover. Given the level of client data that they hold and the role they play in assisting their clients with their finances, cyber risk is significant, making insurance particularly important. Professional indemnity insurance is the most important type of insurance for the financial advice practices. Holding PII cover is a legal requirement under the Corporations Act. PII cover is typically to address client complaints with respect to issues with poor financial advice. It is subject to a limit to the level of cover and an excess. The obligation sits with the licensee to have this cover. However, under contractual arrangements, the cost of this cover is passed on to the practices within the licensee. Advisors who are operating under someone else's licence typically do not hold the cover and may have limited visibility of what their licensee is paying and what they are covered for. An increasing expectation for advisors operating under someone else's licence is that they would be required to pay for run-off cover when they leave the licensee to go to another licensee. This may not be as a standalone policy, and seemingly this is often just applied as a charge from their former licensee, where there is little visibility. We have concerns about how this works in practice. Professional indemnity insurance is also an important factor when it comes to the compensation scheme of last resort, which is a new client compensation scheme that came into place in 2024. The CSLR addresses cases where a client has received a compensation determination from the Australian Financial Complaints Authority. However, this is not paid due to the financial firm going into liquidation. The CSLR has rapidly grown as a big issue for our sector, with a new levy introduced that was nearly $2,000 per advisor for 25-26. There are important issues with respect to how PII works in this case of a licensee that goes into liquidation, and we fear that this cover is not as effective as it should be in protecting the interests of clients. As a result, the cost is passed on to the financial advice profession through the CSLR. The FAAA welcomes this inquiry as an opportunity to consider the implications of insurance for small businesses in Australia. Thank you, and I welcome any questions.
Thank you very much indeed. In your submission, you know that property lines present other challenges, particularly in parts of Australia that are subject to extreme weather events. What are some of the challenges?
Well, our members are located right across the country, so they'll be represented in North Queensland. They'll be represented in flood-affected zones across Australia, whether that's along the Brisbane River or it's in northwestern areas of Melbourne that are subject to flooding. This has not been raised as a big issue by our members, but we are very conscious that some of them are impacted by this. To the lesser extent that they do need to have property insurance in place, they can be impacted by it. But the point we also made is that many of their clients who also live in those same locations will be significantly impacted by that. And to the extent that they are small businesses, this is obviously a factor that we are very conscious of.
The submission, I note, is written from the perspective of financial advisors as small business consumers of insurance as a product. Can I just give you the opportunity from your members' experience point of view, how well is the current insurance market meeting day-to-day needs of professional services for small businesses?
Thank you. So from a professional services entity, professional indemnity insurance is obviously critical. Cyber insurance is also important. There are other property-related insurance and public liability insurance, but if we focus on the ones that are most relevant from a professional perspective, cyber is emerging. I think that we've seen that emerge over the last, I guess, dozen years or 10 years to become a really important part of insurance. That risk is growing, and we know that the actors are out there. We know that already some financial advice practices have been exposed to material cyber risks, and ASIC, as our regulator, have taken a particular interest in making sure that cyber risk management is well understood. One of the ways of doing that is making sure that you have cyber insurance, and when that happens, you've got the support of someone on behalf of the insurer coming in to deal with all the issues that you confront and try and minimise the damage to clients and the business. Professional indemnity insurance is one that's...
Just before we jump off that, we heard earlier today that in terms of the insurance market, that there's a high degree of competition in cyber and that the cost is very affordable and that competition is driving down costs. Is that your experience?
We're not hearing anything from our members to say it's difficult to get cyber insurance or that it's overly expensive. So I guess what that is a sign of is that there aren't significant claims at this stage. Mm-hmm. There will be cases, but you know, we have fears that given what we know in the marketplace, what we know more broadly from a geopolitical perspective is that there are many operators out there trying to breach cyber protections. ASIC have put a lot of effort into making sure that those obligations are well understood by financial advice businesses, as it is more broadly in the financial services sector.
So the risk is being managed in your view?
Well, what I can say is that there's a lot of focus on managing the risk, but it's with cyber, to some extent, it's not a question of will you be subject to a cyber attack, it's when. And you know, the dependency is on a range of tools that are made available, but we see how it's so easy for a breach to occur and for something to go wrong. So we would be concerned that there will be increasing focus in that area, but at the moment we're not seeing a lot of concern addressed to us about the cost of cyber insurance.
Okay. I'm moving on to PII.
Yeah, so PI is one that is so central to financial advice because it is mandatory. It is one that has been in place for a long time. We have had access to PI cover. We've got a lot of experience of the need for PI. In financial advice, it's very cyclical, that you can have a market downturn that generates a lot of complaints. And I think that the global financial crisis was a significant evidence there that generated a lot of complaints. People were invested in products that may have been more risky than matched their risk tolerance. They sustained losses during 2008, 2009, until things started to recover in 2010, but they were down significantly. So a lot of complaints were received. That led to some fairly major remediation programs, but it put a lot of pressure on the PI market. And what we find is that insurers will pull out of PI. They get a series of downturns, they'll pull out. The market will then result in significant premium increases. They'll become more profitable, and then you might, over a period of time, see that the prices start to decline. If you get another major event, then things can go back into that cycle. Our concern about PI is I think we've actually been going through a pretty good period. It hasn't been a hard market. Premiums have been abating a little bit, but we don't know whether that's going to continue. We don't know the extent to which some of the major collapses that we have seen in the MIS market are likely to contribute to a deterioration in the PI market. It remains an ongoing concern. It's that cyclical nature. It's the way that insurers choose to enter and exit the market that causes us the most concern. There was a period a few years back when it became quite difficult to access cover, and that is a particularly challenging situation for a financial firm because PI cover is mandatory.
So this insurers entering and exiting at will seems to be a challenge.
Yeah, I think particularly for certain markets. I mean, we won't see that in the property market anywhere near to the same extent, but the PI market is not large compared to some of the other markets, and it's can be potentially risky for insurers if they get on the wrong side of a major event, or they have insured someone who exposes them to substantial risk. And so that can be the trigger for them to pull out. And of course, we've got more reliance upon Lloyd's syndicates in that than we do in other markets. So you've got that overseas exposure as a factor as well.
So that was going to be my next question. So if I put it to you this way, in your submission, you note reliance on Lloyd's capacity in the PII market. From a small business perspective, how does reliance on overseas capacity affect stability, pricing and availability? And have you got any recommendations about what might need to happen?
Not so much in terms of recommendations. I think one of the things we've tried to make clear is that our members are typically small businesses, but often their insurance is obtained via their licensee. So their licensee may have greater capacity to go and seek insurance through overseas markets.
Through a broker or directly?
Well, in our view, it's essential to be using a broker in the PI market. Firstly, you've got to make sure that you've got the right cover. There are standards that are set through ASIC's regulatory guidance. So you've got to make sure that you have compliant cover, and you've also got to have the knowledge around the market and where to get that cover from. So yeah, we've said we think that going through a broker is particularly important, and the brokers do play a role in making sure that that they can do their very best to access cover, and that they can help the firms to manage issues that emerge should there be any claims that arise.
I have got some more questions, but I'll cede to my colleagues now. Okay. Do you have any questions, Ms. Jarrett?
I do actually. Just on the PI market and with the the entry and exit at will, basically, is that what happens in other markets overseas? Have you looked at other markets and seen what's happening in that space, or is that unique to Australia?
I'm not really in a position to comment on what happens in overseas markets. I think the Australian professional indemnity market is not a large market, and we are to a greater extent reliant upon overseas providers of insurance. So I imagine that in the issues that we may have here are not so much the same issues as you would get, say, in the UK or the US, where you have larger markets and more operators at play.
So with the reliance on overseas insurers, like how many insurers are providing that insurance? Are we very and given what you've just said about, say, the US having a bigger market, is there a limited number of insurers in the professional indemnity market here? Is choice limited?
So yes, choice is limited, and it has been an issue over recent years with exits, and then the very limited number of domestic insurers, which has forced people to try and go to the Lloyd's market to find solutions there. That operates in a very different way, and that the way that they package up insurance is quite different, because it's the syndicates rather than the Australian companies. But there's some larger Australian players in the PI market. There's some of the US, well-known US entities that have participated and come in and come out of the market. But if you're talking about the number of options that are available, it is very limited.
It's limited. And
can I just check who's in? Some have come, some have gone. Who's in?
Look, I want to be careful about saying this.
Take it on notice.
Yeah.
If you
Thank you. That would be.
Yeah.
That would
So
probably be
if you
best.
can give the shape of, when it was it functioning really well, how many did we have and who were they? Give us the story of who exited and any rationale for what you understood happened there, and then who have we got now?
And just on top of that, if you don't mind, Chair, could I ask
Please.
also that we add to, like, how have the products changed? Because I assume that you're not just buying at various periods of time private indemnity insurance. Are they packaged? Are they bundled? But yeah, an indication of how those products have changed, I think, would be also helpful. Can I ask one more question?
Yeah, go.
So, but I can actually respond to that. Sorry.
Great.
The ASIC provides regulatory guidance around how the product needs to look. So there's certain rules in Regulatory Guide 126. So the product hasn't substantially changed because there's a need to continue to comply with what ASIC expects with what's in the policy.
I get that, but if the product is bundled, if the private indemnity piece is bundled with others, and that's what's sold to your advisors or the licensees, maybe that, if that's changed and maybe that's creating issues, I don't know.
Yeah, look, I'll take that on notice to check, but it's my understanding that PI is not a product that is bundled with other products.
It's often a standalone. Okay, that's good to know.
And so what I was explaining before was that the licensee is responsible under the Corporations Act to have PI insurance.
Yeah.
And so that's the one that will almost invariably be in the name of the licensee. When it comes to property, the licensee will leave it with the individual practices to put their own arrangements in place.
Oh, I see.
They may, when it comes to cyber, mandate which policy, but typically the policy will be with the practice, not with the licensee. So insurance is put in place in different ways across the different product lines.
Okay, I understand that. So we might see the licensee being the holder of the private indemnity, but then all your individual advisors who are operating as, 2 or 3 person shows, they're the ones in that put in all that other insurance. They're the ones responsible potentially for property, cyber, business continuity insurance, for instance. Yeah.
Yes, and
Okay.
it will, in terms of the PI cover,
Yeah.
because they are small businesses licensed by a licensee, whether that's a smaller or larger licensee, they will pay the cost of the PI. That will be through a contractual arrangement where, so the licensee has gone out there and got cover for all of their different authorised representatives for all of the things that they do, and then they will apportion that to the individual practices.
Oh, I see. Okay, thank you.
Is that transparent? Does the licensee have to reveal to their licensed entities the actual cost and how it's distributed across the entire network? Or I'm just thinking about evidence we received about franchising, where that there was shocking exploitation of franchisees by the franchisor, who basically it was costing more per unit of milk than you could buy the milk down at the local shop if you were purchasing it at retail. So, is there sufficient transparency for those further down the food chain, if I put it that way, to see what the real cost of the insurance is?
I would answer that by saying there is no legislated requirement to provide visibility. I imagine that some licensees are better at it than others, but we certainly get feedback from some of our members that they don't know whether they're paying what it's costing the licensee or whether the licensee has built something in to the premium, whether that's built something in to cover their costs in managing the overall program, or whether there's a profit margin in it. So we do get feedback from our members expressing concerns about that. And Chair, the other thing that we did talk about in our submission is some of the licensees now require run-off cover when an advisor leaves a practice.
Yeah.
And one of the most significant stories recently with respect to one of the licensees that was caught in their Shield and First Guardian debacle is that they were requiring their advisors to pay for 2 years of run-off cover.
Okay.
Now,
So let's talk some numbers here. What would that say? Say I'm working for licensee, J, and I decide that I've got a better offer from somewhere down the road. I'm running off. I'm assuming that's where the expression comes from, to work in another licensed company in the same industry. How much does run-off cover cost me? How is that apportioned?
So this is the interesting thing about the visibility of it, is it's our assumption that they're not actually going out there and putting standalone policies in place. They are collecting money to cover the fact that they will need to continue to pay premiums even though that business is no longer with them. So we work on a claims made basis, so you need to have cover at the time that the claim was made. And when it comes to financial advisors, the liability with respect to the provision of advice sits with the licensee at the time the advice was provided.
Yep.
So if you change on the 1st of January 2020 from one licensee to another, the old licensee is responsible for the financial advice you paid before the 1st of January 2020, and the new licensee is responsible for it afterwards. Now, so the licensee is saying, well, we're still responsible for the advice that you've provided in the past, so there's an ongoing cost. But the question is that...
But you're not charged that cost as you are creating the risk. You're charged that as, if I could put it this way, a coercive strategy to keep you where you are. That's how it could operate.
Some would argue that run-off cover is a barrier to leave.
Yeah.
And given that it happens in circumstances where standalone cover is not actually obtained, and in the particular one that we're talking about with Shield and First Guardian, it is unimaginable that this particular licensee would actually be able to obtain that cover anyway, given all the other circumstances that are involved. So yes, we are concerned that it is used in a coercive way. There is a genuine ongoing risk.
Can I just ask how much? How much would it cost?
So it
need to
varies.
leave?
It varies depending upon the scale of the business
Yep.
and the type of services that they've provided. But I've spoken to someone recently who said they were charged $10,000, which was supposed to be 2 years of PI. I think that's at the really low end of the spectrum. Others that we've spoken to were being told they needed to pay more than $40,000 just to leave that licensee in order for that obligation to have runoff cover met.
And the calculation is based on what? How much do they think the person will bear as they separate, or based on any risk assessment of the type of product they've sold, or is there any transparency around this runoff cover at all?
So we can only answer that question on the basis of what we've been told by our members, and to the best of our awareness, there isn't transparency, there isn't clarity as to what the drivers of the cost are. So if you're running a large licensee and 50 advisors have left, how do you price that risk? How do you might have gone from a licensee with 250 advisors down to one that's got 200 advisors. What does that mean to what the cost of PI insurance will be going forward? How do you apportion the cost for those that are ongoing versus the liability that remains for those who have since departed?
Yeah.
It's very difficult, and I'm not sure how licensees are explaining that to their advisors. My understanding is they're not giving them much information. They're just saying, if you're going, we've got a continuing liability, you have to contribute.
Could I just one more question? If this is a standard practice within your sector, if I'm moving to a new licensee, does the new licensee actually pay that rather than me as the advisor?
So if you move to a new licensee, then the new licensee will pay. You'll have to pay them for the cover from the day that you start with.
Yeah, but
them.
will they pay your effective golden
To
handcuff
purchase you,
to
basically.
purchase you back?
No.
That doesn't happen.
No, I think that would be very unlikely. The licensee business model is fine margins, so they don't have the capacity to do that.
To look at who carries that burden. Yeah.
So
The burden is carried by the advisors.
By the advisor.
Yeah, there's no question about that.
and the licensee, having purchased PII from, name a company for me that I could purchase it from.
Well, CGU.
Okay. Let's just go with CGU for today. So with CGU, I am the licensee. I've purchased the insurance for 200. How do they calculate the risk?
So what an insurer will do is they will collect a range of data that they have on that particular licensee. So they will be interested in how many clients they have, how much assets under management they have. When it's life insurance, how many life insurance policies. They'll be interested in their exposure to higher risk products. They'll be interested in their exposure to more risky services. So there's managed discretionary accounts, or they are operating in other non-conventional spaces. So there's a range of considerations, and an insurer will underwrite that risk taking into account all the factors that contribute to that. So that's the overall cost at the licensee level. The licensee then needs to apportion it to individual practices.
Yeah, okay. And the profile of those different practices could be quite different, but the data is available. Right, the data that informs CGU is there. It is known to the licensee. They have to collect it to provide it to the insurer.
Not only do they have to provide it to the insurer for them to underwrite the policy, but their ongoing management systems will show them where the money sits. They will get reporting on where the money sits, how much sits in each of the platforms, how much sits in each of the investment options within those platforms. Their data should show them all of that.
And to the best of your knowledge, is that detailed data that is held used in any way to transparently price the risk that is managed currently in the current practice as run-off cover?
So what I would respond to that by saying is that I think that data is used for the basis to apportion it to existing advisors. I think the message we're getting back from our members is that the way it's used in terms of run-off cover, because run-off cover is a different proposition to ongoing insurance. So the feedback we're getting is that there isn't a lot of transparency around how some of these run-off cover costs are being calculated.
Okay, that is most interesting. One of the points that you made in your submission is improvements to PII across financial services value chain, as well as recommendations to improve data and monitoring and to increase the effectiveness of PII for entities in liquidation. Can you speak to this recommendation around data and monitoring? Because I have concerns about who gets to see what already, and without transparency, severe exploitation is possible if someone is so inclined. And we haven't been able to kind of get data from actuaries who are saying that some of it's held by APRA. They can't see what's going on. So I'm getting a sense of many dark places in terms of the insurance sector that we have little scrutiny of. So what data and monitoring are you referring to?
We've, in our earlier submission to Treasury on the PI market, we've talked about data in a number of different places. APRA is the regulator for the insurers, and they will be collecting data, but the question is whether it's granular enough to understand what's happening in particular markets. So our interest is around PI cover for financial advisors. Do they just collect data at an overall professional services level rather than more directly in our particular sector?
And your recommendation would be?
Well, our recommendation would be is we would like to see more data available. We would like to understand how profitable the insurers are in our space. So that's at one level, is market level data. The other data that we've talked about, which we think is particularly relevant, is the data that goes to the regulator. The RG 126 says you've got to have a minimum of 2 million, and plus it then goes up on a sliding scale that your revenue, for every extra million in revenue, you've got to have another million in cover till you get to 20 million, and you don't need to have more than 20 million of cover, which isn't always enough, and particularly if we look at some of the Shield and First Guardian matters, I think the proof will be there. What we're conscious of is there is information that needs to happen as part of an AFSL audit, but we're not seeing evidence that is being checked to make sure that licensees always are complying with the minimum requirement. So we think that there is more data that can be available through that pathway, and cases where licensees don't have enough cover, then we would certainly like there to be more regulatory intervention to make sure that they do have enough to avoid some of the risk of client detriment that we have seen.
Okay. Thank you. Thank you very much. I'm not sure if this is an appropriate question for you, but given that financial advisors are interacting with the small business sector on a pretty regular basis, they're not just providing personal professional advice, they're providing advice to small businesses across the country. Are you in a position to give me any idea about the insurance challenges faced by the small business insurance market more broadly?
So I think that financial advisors are unlikely to be giving advice with respect to clients obtaining cover. I think that's really the space for general insurance brokers, and you'd have to be licensed to be providing that advice. So we're not getting feedback about issues that emerge, but they will be asking their clients questions that you have insurance in place. It's part of the fact find process. If they get answers back that signal that there may not be adequate insurance, then that may lead to a conversation that encourages them to go and speak to a general insurance broker. But it's not something that we're getting a lot of feedback from our members, or we're getting any feedback from our members on.
Okay. That's it for me. I probably have a few more on notice, unless there's any. Mr. Bockholtz, yeah.
Mr. Anderson, previous evidence we heard from different groups that suggest that the cost of insurance in their business is, in some instances, third on their cost behind
supplies,
wages and other.
I suppose.
Cost of goods. Yeah. Professional indemnity insurance. Do you have a sense of what proportion that cost is for a typical broker or a member?
Yeah, for a financial advisor. So we would certainly not suggest that it was anything more than 10%. It's probably a question I'm better to take on notice.
Yep.
But I imagine that they could be paying $10,000 per advisor when the advisor, given that the other costs within the business, will be generating at least $300,000 of income. So if you look at it in that perspective, it's not a high percentage of total revenue.
It traditionally, has it always sat around that 10%, or has that?
Oh, sorry, that's even less than 10% that I'm talking about there. It does oscillate, and as I was talking about before, the cyclical factors in the market. So it can go up and it can come down, and it varies from one practice to another depending upon the extent to which they're doing higher risk activity, or they're exposed to higher risk products. So no, I don't think it's ever gone anything near 10%.
Yeah, thanks.
Just one final question, if I could, with regard to liquidation. You made a point that the claims made basis is an issue where there's no longer insurance in place at the time of a claim cancelled by an insurer. Can you just flesh out the challenges there and what a fix might look like?
So, and this is obviously very directly related to the compensation scheme of last resort, because we're seeing cases of this, and the visibility of it has significantly increased.
Yeah.
So when an advice licensee goes into liquidation, seemingly many of the policies allow the cover to be cancelled. Now that might be despite the fact that there is a period still to run on that professional indemnity insurance. The other thing that we're discovering is that for the liquidators, there's little incentive for them to pursue recoveries from PI insurers because it's uncertain, they don't have the expertise in it. So this is a point of concern for us, that PI becomes much less effective when a financial firm has gone into liquidation. And that either serves to the detriment of the consumer because they no longer have the capacity for that recovery, or alternatively, the client is able to seek compensation through the compensation scheme of last resort. So we are, and we have provided...
It's kind of pushing on which door's easier, really, though, isn't it? I mean, like, the insurer just goes, oh, well, we're out of here. And they've got alternatives anyway. The alternatives, though, are the public purse, as well as, your sector, and everybody who contributes to the CSLR.
Yeah, so I don't see there's much opportunity to access the public purse unless we're talking about people who will become eligible to pensions instead of being self-funded in retirement.
Yep.
But yes, it it changes the dynamics of it. And from a liquidator's perspective, this is not their core market. Their job is to try and wrap up the liquidation as soon as possible. Plus, you've got complexity around where it is an insurance recovery. That recovery is an asset of the individual making the claim rather than the liquidation as a whole. So there's a range of things that contribute to the fact that it may not be as high a priority for the liquidator to seek a recovery or to continue to pursue a recovery that's available through a PI policy, as it is for a business that's an ongoing business, where it's absolutely critical for them to make sure that they can recover money through the PI policy to pay the claim to the client.
So if the PI policy, finishes in June, but the company has gone into liquidation in March, you would assume that the policy would still stand if they've already paid for it.
It's our understanding that many of the policies allow that policy to be terminated straight away without any refund of outstanding premiums.
So it's okay to change firms to a licensee. You have to have insurance to make sure that the licensee has insurance coverage. But if if they go into liquidation, there's no requirement for that for insurance to continue.
Well, it's probably one step further on from that. They have lost the insurance that they previously had. And where this comes into play in terms of client complaints is that ASIC always expects a licensee to remain a member of AFCA for at least 12 months after they go into liquidation. So that allows the clients to make complaints to AFCA to seek compensation.
But there's no there's no compliance requirement for insurers.
Well, there's no compliance requirement for the insurers, and if the policies allow them to terminate the policy, then that can happen. What it does do is mean that the clients still have the right to complain, but they will need to rely on the CSLR unless there's other assets in that liquidation, and often there aren't other assets in the liquidation. So it ends up being a cost to the CSLR.
So the only asset might be the insurance.
Yeah, but if the insurance has been cancelled because they've gone into liquidation, then it's only the cases that have been submitted with the insurer before the cover is cancelled where there may be a continuing capacity for the PI, for the liquidator to seek recovery from the PI insurer. But the question is, how high a priority is that for them, because they're not the same as the continuation of the owner of the business, who would obviously have more incentive to pursue that cover rather than a liquidator who has all other things to manage and doesn't have the skills necessarily to pursue that PI claim.
Can I just clarify? So does the insurance get cancelled as soon as a licensee goes into liquidation? So I'm hearing two different things. I think that maybe yes, but it's because they're lower down the totem pole when it comes to liquidators stepping in and doing what they would normally do.
So just to explain that, the Treasury did a consultation on this, issued into I think December last year, and specifically talked to the fact that Australian policies tend to allow the insurer to cancel the cover when the business goes into liquidation. Apparently in the UK, that's not allowed, but so some of the policies that are on sale in Australian markets will allow the insurer to cancel the cover, and it's our understanding that there's no refund of the outstanding. The other point that I was making was with respect to the PI insurer and with respect to the liquidator and the extent to which the liquidator has a focus on pursuing PI claims. Now, given if they can't make a claim after the policy's been terminated, but they may still have existing claims that were notified to the insurer
Prior.
before the company went into liquidation, and it's the extent to which they continue to pursue those and continue to work through the matters that may be there with AFCA, for example.
Thank you for clarifying. I get that now. Thank you.
What sort of skill set would you need to have? I mean, liquidators are pretty skilled. What makes you assert that they are not sufficiently skilled to undertake this role of the recovery of assets through a PII claim through a major insurer?
So, good question, Chair. I think there's two elements to it. One is the administrative exercise that they need to go through.
They're already busy doing their other job,
Yeah. The other one is where the matter may be of a more technical financial advice nature, and it may be that the actual claim is still in play and it's still going through AFCA. We're finding that they're not responding to AFCA complaints, so it's left really with AFCA to make the decision. So there's a couple of different elements to it.
and there's delays in that system. It's quite burdened.
There's delays in the AFCA system. It always takes a period of time to work through the process, but what we've seen more recently is the huge number of Shield and First Guardian claims is putting a huge workload on AFCA. The latest numbers for the 25-26 year for the first 9 months are 1,800 complaints for the 5 licensees involved in Shield and First Guardian, which in comparison with where we were as a profession 3 or 4 years ago, it was less than 500 complaints for the entire profession for the entire year. So yes, the pressure on AFCA is substantial.
Yeah. Okay. Well, thank you very much for your evidence today, Mr. Anderson. I think you've got a couple of questions on notice there. There may be a couple more. If you could provide those to the Secretary by Friday, the 29th of May, that would be much appreciated. Thank you.
Thank you.
I now welcome Mr. Alex Cairns from the Australian Tattooists Guild.
Hello.
Hello, Mr. Cairns. How are you?
Good, thank you.
I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you.
Yes.
For the Hansard record, would you please state your name, your full name, and the capacity in which you appear today?
Okay, my name is Alexander Rusty Cairns. I'm appearing today in my capacity as President of the Australian Tattooists Guild. To give a little more background, I'm a senior artist of 20 years with international recognition. I'm co-owner of Lighthouse Tattoo, another internationally renowned tattoo shop, and I feel quite qualified to comment on this matter.
You've been observing for a while.
Yeah.
I now invite you to make a short opening statement, and at the conclusion of your remarks, I'll invite members of the committee to ask questions. Mr. Cairns.
Okay. I'm assuming you guys have read the submission that we put forward.
Yep.
The basis of our sort of case is that there's an overall risk assessment of the tattoo industry that's probably outdated, and it relates to a perceived involvement from organised crime. We feel that risk assessment is probably out of date by about minimum 15 years. There's been a lot of regulatory changes that have seen very identifiable evidenced changes for the positive, especially in the last 10 years. And while the liability side of insurance is, I'm going to say, expensive, it does cover us for a lot of stuff, and I feel that's not so much the problem that the industry has a problem with. Building insurance and contents insurance, so basically insuring assets, is the problem. Building insurance premiums have gone up by so much, and you're paying in most cases you're paying the building insurance for a landlord. So you're insuring an asset you don't own, but they are entitled to pass that on in full to the tattoo business as the tenant, because it's perceived that their business is the thing that's increasing the risk profile. And this is like a real business killer, because it's, in some cases we're talking as much as, $30,000, $40,000 rental increases on a place that might only be sort of $60,000 to $80,000 in actual rent. So it's a huge outgoing.
Sorry, could you just take those numbers again for me?
So, okay, you might be paying 60 to 80,000 a year for your premises in rent.
Yep.
And then some of these insurance costs, like a minimum is going to be 16,000, but we're talking up to, in some cases, 39, 41,000 to insure the building. And the higher numbers are definitely where strata title's involved. And but all of this relates to the perceived involvement of criminality, and I guess the risk assessment models are made over, decades. But our argument is that basically it's out of date by at least 10 years, and it serves to uphold a monopoly. There's very few players that want to insure it, and so they're able to charge as much as they want by harping on that. There's no incentive to change the risk model. We've been able to introduce. The Guild has worked with a couple of brokers closely who have been able to leverage our code of conduct and articles of association as evidence of reduced risk, along with citing evidence around the probity-based licensing systems in New South Wales and Queensland. All of these measures designed to sort of vet licence holders for involvement in criminal organisations. I can go into that later if you have questions, but they've been able to sort of entice a couple of underwriters to issue policies for building insurance where there's a tattoo business as a tenant, and the savings are like 50%. So we're talking some of these premiums are going from 16 to 6 or 7,000 to insure the building. The thing is, you can't. This isn't universally available. It hasn't worked with buildings involving strata title, and you also need to have a willing and cooperative landlord that actually wants to change insurer. Often they've got these quite embedded kind of relationships with the insurance brokers, or the real estate agent does, and there's many barriers to you being able to actually obtain a competitive quote. And to sort of further evidence that the main broker that's handled tattooing for the last sort of, I'm going to say 15 years at least is Gallagher. And yeah, the Arthur Gallagher? No, okay. So that's a broker, and the policies are underwritten, I think, by Lloyd's in the UK. Some would argue, and this is just sort of, I guess this is hearsay, but they have an incentive to uphold that sort of perception of risk, because they're getting all the money through it. And it means that other players are reluctant to come into the market. When they've seen other players dipping their toe in the water, they've come back to us and said, we're able to reduce our premiums by 20%, which doesn't increase, that doesn't imply that the risk has gone down. That just implies that there's competition, which is actually what the industry is lacking. So, I guess.
So you're talking about a business model by Gallagher's, the key broker for your industry, underwritten by Lloyd's, of continuing to take out their competition when they're advised of a competitive process.
I don't think they're taking out their competition, and it's not transparent. It's hard to get proper. It's hard to get a very accurate sort of experience of what's going on. But when you talk to brokers, we've been approached by multiple brokers over the years whenever this story sort of comes to light on the news or something, and they come and they say, oh, look, we should be able to help you. And they go out and sort of try and, I guess, find other underwriters. And some of them come back going, I couldn't find anyone. Or they come back saying, Gallagher already handles that. Or there's just some sort of, barrier. So there's been very few that have been able to kind of actually find other underwriters to cover for building insurance, and also contents. Building insurance is the big one, because obviously you have to have it whether you own the building or not. But contents, you often find a lot of businesses are choosing to self-insure, because some of these policies are $8,000 a year for, I don't know, $120,000 of coverage. I mean, you'd rather just hang on to that money. And there just aren't the number of incidents to sort of justify the risk assessment.
Okay. I've got more questions.
Yeah,
but
yeah.
I'll-
But I've brought some numbers like for some sort of freedom of information stuff to do with licensing in New South Wales, to sort of, because that heavily relates to. I don't know if you know much about the New South Wales licensing. It's the same in Queensland. They every tattoo artist and it runs similar to the security licensing regime, and it's actually run by the same branch of the New South Wales Police. And so every artist, every business owner has to be fingerprinted, have background checks. So it's got nothing to do with competence as a tattooer. It's literally just a check for background information. And they're even allowed to they're allowed to include the use of secret information that they don't really have to disclose to you. So essentially, they don't have to disclose to you the reason for denying your application. And they have their reasons for that. However, the numbers of actual licence refusals is very low. So I've just got some.
What do you mean by low?
Oh, okay. So let's go. So up to 2000 because the other thing is that it recently went from fair trading to SLED, which is the Security Licensing Enforcement Directorate. I think that's what it stands for. It's a branch of the New South Wales Police. So up until 2000, up until they took over, which was in 23, there were 1,550 tattoo artist licenses granted and 465 operator, which is the master license for a shop, granted. And then in total, so since the regime came in 2012, there's been a total of 3 license denials. No, sorry, I'm just adding these together. 7 license denials related to links to organised crime.
Okay, and what period of time was that?
12 years, 2012 till now.
Okay.
So, I mean,
so the risk
that would imply that they've really
pretty low.
Well, according to those figures, it would imply, that it's very low. If you look at what's happened in Queensland, they handed over they're pretty much a mirror. They're pretty much a copy of the legislation, except Queensland added a health department cross-contamination unit to it as well.
Yep.
Now, they handed over the management. New South Wales handed over the management completely from fair trading to New South Wales Police, and in Queensland they handed it over from fair trading and police to Queensland Health. And they wound back a few of the police checks that still go on there, so that you don't have to have your close associates vetted in some circumstances. So like landlords, and the network of close associates is smaller. So they basically wound back a lot of the police checks in Queensland. And lo and behold, it didn't produce any increase in evidence of criminal behaviour, or basically firebombing is what they were concerned about. This is the thing that happened. We're talking decades ago, and not even that much.
Now, my question,
Mr. Buchholz, yes.
Thanks, Chair. Thank you, Mr. Cairns. I really appreciate you giving evidence today. I'm finding your contribution fascinating and salient to some points. When the assurers are making a risk assessment on you, that you're making the claim that the assessment is out of date. Mm-hmm. Why do you think? How would I argue to the Insurance Council that criminal minds, gang-related effects, are no longer a risk? What has changed to make the industry no longer a risk?
You've got the introduction. Well, okay. The main thing is you've got, basically layers of regulation that are specifically designed to weed out criminal involvement. So New South Wales is very targeted in that area, and that legislation, I'm going to argue, has produced success. Queensland the same. South Australia has a slightly different version where you register and they basically will approve you or not based on, criminal record, links to known figures of organised crime, links to gangs and things like that. And if you pass, you can trade. It's not a licence, but it's a registration scheme completely designed to vet for organised crime. So that has definitely changed, and it's been enforced now. We're talking 2012 till now, so we're coming up 14 years. Another big thing that's changed is I guess the proliferation of tattoo shops has created more competition, which means that relative to wages, tattooing is probably cheaper than it was 20 years ago. So it's not like a controlled substance that organised crime wants to put its...
High margin.
Yeah, high margin, and the margin's lower, but the profit's not there for them to kind of, if you're if you're trying to engage in things like, say, extortion or, embedding yourself in the business, the profit has to be there, and you've really got to put your face to it. There's so many. I mean, even to get DA approval for a business now, you have to submit this is in New South Wales, you have to show, and this is to council, what your security measures are. So you're showing them what type of cameras, how much of the shop is covered, how much on street, how that links up to, how long it can record in terms of like the size of your hard drive. So these are all things that you have to have in place to get development, your development approval to even open up business. It's not necessarily attached to licensing, but these are all checks and balances based around vetting out criminality. I think the margins aren't there for organised crime, and the licensing has created another barrier. That's the change.
Yep, good. Have you made representation to your insurers and shared the salient points?
Yes.
What's been their response?
Gallagher kind of presents it like, I mean, they are the broker. Gallagher presents it like they're not the ones making the risk assessment. It's the underwriter, and they.
Which is in most cases Lloyd's.
Yeah, I mean, it all ends up going back to Lloyd's. Even the brokers that we have been able to, get other, like, I guess, different, like, not through Gallagher. So I don't think Gallagher's the problem in this case. It's just they've been able to sell our industry to another part within Lloyd's that's seen us as being profitable enough to dip their toe into that. We have made, not directly to the insurer, but through brokers. But yeah,
you have seen some decrease in premiums by clustering with your broker.
Some, but it's not available to everyone. It's not blank. It's
only for freehold property and
only
not
for freehold
strata.
Yeah, only for freehold, and not in not every case are you able to do it. The other thing is that you're not the policyholder. This is the other huge problem, is that basically you need a cooperative landlord that wants to go and seek. Like, there's no one. The real estate agents and landlords are not incentivised to get, and where there's a kickback arrangement between, say, the real estate agent and the insurance broker, they're actually incentivised to get higher price policies because they get more out of it.
Understood. Sorry, I understood the point about the strata title, where the
strata's
you're a subset of their insurance policy.
Yeah, but the increase to the entire building that is collectively insured, that's all funneled to that one tenant, causing the increased risk. And there's no other, none of the other owners are incentivised to wear any of that cost. Occasionally you do, but that's all just sort of goodwill and people kind of choosing to allocate, spread the loss out. But it's not, you can't rely on that. In the individual businesses where it's freehold, though, you still need a cooperative landlord, cooperative real estate agent. The relationship needs to be good. And there's also examples where they just haven't, the broker hasn't been able to obtain cover with, another underwriter for whatever reason.
So you're suggesting that there's precedent with Gallagher and Co. for cheaper premiums, and you're asking the rest of the industry to acknowledge the different risk weighting that one broker, or through Lloyd's, applies to what the rest of the industry applies. And you're claiming that they're out of date.
I mean, Gallagher hasn't actually been providing the cheaper quotes. Is that... Sorry,
yeah, I thought they were.
No. Well, no, they came back with a 25%. Well, they claimed up to 25% reduction. I'm yet to see evidence of it, because we've also got members that are coming through in a panic going, you know, we've just got our insurance bill back from the landlord and it's up by another 2,000. So I think that is actually like I think that's a marketing tool for them to try and get more people on board, right, and to try and scrape back some market share from the really small amount of other players that are coming into the market. There's a broker called Apex Insurance that's been able to get some cheaper stuff with us, like we've been working with, and they're the ones who are, you know, looking at the code of conduct and stuff. There's another insurer that has been claiming to be working on behalf of the industry. I'm yet to speak to them, and I'm not sure if what they're offering pertains to building insurance or just liability. But there's more work to be done. Like by us, we need to speak to them.
Thanks, Chair.
Can I just ask a little more about Apex?
Yep.
And then I'm going to go to Ms. Jarrett. So
Okay.
who is Apex, and how have you found them, and what have they done?
Wait, let me just grab out the contact. Okay, so okay, Apex Insurance is basically a broker.
Yep.
The main person within that we've been working with is Shervin Naderi, and he's basically been, according to him, working with contacts inside Lloyd's to place policies in other, you know, sections within Lloyd's. It's hard to know, like from our perspective, the whole process of that is not very transparent.
Has it manifest itself in reduced premiums for anybody, or is it still on a promise?
No, for those people, yes.
So the $16,000 down to 6 or 7
Yeah.
has actually occurred as a matter of fact,
Has occurred, yes.
and been largely provided by Apex
Yeah.
brokers,
These are those examples are ones that have actually occurred.
who assert through their efforts with Lloyd they have been able to get better prices.
They weren't working with Lloyd's.
Oh, who are they working with?
Sorry. Lloyd, yes. Sorry, I'm mixing Gallagher and Lloyd's. No, yes. Through Lloyd's, yes.
Yes, okay. So Lloyd's, somewhere in Lloyd's, there are responsive underwriters who are looking at what you assert is a changed market since 2012, which has now proven over 14 years to be a lower risk. And Apex are able to provide a discount from 16,000 down to 6 or 7, which is very substantial for a business,
Yeah.
you know, dealing with the, you know, a couple of $100,000 as its turnover, I'm assuming.
Yes.
So there is a degree of competition, but it's only for freehold, and it is limited perhaps to, is it the larger entities rather than small ones?
I think probably small ones would be better suited to it. But
Okay.
the issue is that they're not confident. Like for some reason that just, you know, me not being in insurance, it hasn't been successful. It hasn't had blanket success. So
It's patchy.
Yeah, and so what that means is that it's not something that they want to go out on a limb and advertise. We can advocate for
Okay.
the tattoo industry or whatever, because they feel like they can't deliver on that promise consistently enough to be going out to the
Head-to-heads.
tattoo market to
Yeah.
be getting that. The other thing is it's very hard, and this is something that Gallagher's expressed, and I understand this, is that it's very hard for them to kind of tailor and market a product that's aimed at, because the policyholder is not tattoo businesses
The policy.
in these cases. I mean,
Yeah.
contents is, but building insurance is the big one that everyone's sort of screaming out about. I mean, I think contents is a real issue, but people have just put that on the back burner because this is.
When you say that, you mean that people are choosing not to insure.
Yeah,
They just wear the cost of losing.
but it's very expensive for the same reasons.
Yeah.
Like I would say it's bad value to the point that a lot of businesses don't do it.
Yeah.
And there's other ramifications that sort of that has the contents one is that. Okay, an example is you often have shops that provide tattooing and piercing. Now, the cost of, say, gold jewellery and insuring assets that are held on premises because there's a tattoo business, end up being way too expensive, and so some of those businesses have had to split up. Also businesses where you've got, say, laser tattoo removal housed in the, like as part of the service that this tattoo shop provides, that's now getting broken up as well, because you've got a cutting edge laser is going to be anywhere from, now they're somewhere around 200,000. So if you're insuring that piece of equipment under a tattoo shop risk assessment, you're paying way too much to have that thing insured in that premises. So there's sort of indirect things that flow on from that.
Thank you very much. Ms Jarrett.
Just a couple of follow-up questions. With what you're seeing in the market here, do you know, are you seeing the same thing overseas, or there are other markets where they've managed to get this right?
Look, when I speak to other people, it is not the same issue. Okay. And I'm not speaking to insurance brokers or companies overseas. I'm speaking to, say, other business owners in other countries. But I think they also don't have, there isn't I feel like there isn't this sort of perceived necessary association of criminality. Like, I think there's
but there would have been at some point, right?
Maybe they're further out of it. Like maybe it's further behind them in terms of the timeline. I'm not exactly sure.
But you're not seeing the same. So there are other markets where where the insurance is working quite, say, in a less expensive way for your industry.
It's not something they're complaining about.
They're not complaining about. Okay. And then, in terms of the building, you talked about building and contents, and they're being separated. Is that something that your industry has pushed? Because quite normally in the insurance product market, you'd see building and contents as one.
Well, I guess in the commercial sense, you've got the building, which is the landlord insuring their building, right?
Oh, yeah, of course, that's why.
And then you've got the contents is basically the business you're insuring everything from your fit out, to everything inside. So if the place burns down or whatever happens to it, none of your fit out is covered by the building insurance.
Yeah.
But you're paying a lot of money for an asset you don't own.
Yeah.
Yeah.
And is there sufficient transparency from you as the business renting the building, having to pay the building insurance? Have you got sufficient transparency into what that insurance is? Because I'm thinking, we've had a lot of, we've already heard from people in terms of we have high risks at the moment with climate change, etc. I'm just wondering whether the cost that you're paying is also tied up in, or your industry's paying is also tied up in those other costs. Do you get sufficient transparency into the risk basis for?
No.
You don't? Okay.
No. And I think there's a couple of reasons for that. One is that, I think it's obviously the bread and butter of insurers to sort of not, if they don't, they're not incentivized. I can see why they're commercially not incentivized to tell you. But because you're sometimes in good, I'm going to say good examples, you get cases where the landlord is very transparent with the tenant about their insurance costs, and they're showing them the policy and they're doing, all this sort of stuff. Often you also see examples where they sort of keep that card close to their chest because there's probably there's a few people, there's a few fingers in the pie. So you've got a strata committee, you've potentially got a chosen broker. It'll open up the landlord or real estate agent to scrutiny as to whether they actually did seek competitive quoting.
Yeah.
So you often find examples where they're not transparent about that.
I suggest that the environmental change for you is a Molotov cocktail coming through the front window.
Oh, say again? Oh,
to the. Sorry. So you go, Senator.
I just wanted to ask. So basically, what you were saying in terms of the transparency or lack of transparency, the holder of that information could be a number of different players. It could be the landlord, it could be the broker, but at the end of the day, you and your industry are not seeing, you don't get visibility into that. You get a bill and boom, you have to pay predominantly.
In the worst case scenario, and it's common enough that that is the case.
Yeah, thank
Yeah.
you. Okay.
Really interesting.
Do you have any more questions, Mr. Buchholz?
No, I think it's very interesting, and I think it's you've given clear evidence where you perceived as an industry that the risk assessments are being made on an environment that was over a decade ago. You've cited clear enough evidence that that risk is abated through regulatory intervention from state levels. I and the committee we will ask those questions of the industry as to why, when evidence is brought along the lines of which your industry has brought us today, why we're not seeing a reduction as the risk.
If they could draw a line in the last 10 years, like draw a line in 2016, and just went, how does the previous, I don't know how long their risk assessment models are, sort of how many decades they're calculated over, but just kind of go a number of decades before that compared to the last 10 years, and just sort of see honestly what that looks like. I'm very confident it would be, because every time we have meetings with, last year I was in a meeting with the police minister. Every time we have, we have regular contact with the SLED agency, the police directorate, when it comes to licensing issues in New South Wales. Every time there's these sorts of interactions, they agree that there isn't the evidence to support any criminality. And I know I'm focusing a lot on New South Wales, but it's probably the biggest market, and it's also the one with the most data around criminal stuff. But the other states reflect the same sort of patterns.
I think it's a fair enough question, and the committee will pursue those questions to the Insurance Council.
Thanks.
Thank you for your submission. It's quite powerful in terms of the impact statements that you've gathered here to give shape and form. I'm just looking at one here. Somebody's been a tattoo artist for 23 years. They pay a specialised insurance premium of $20,000 and a further $20,000 up front for the forthcoming lease period. Our policy all of a sudden increased by 70,000. 70,000 per year. That was at Victory Tattoo Co.
I don't understand how that could even be payable.
Well, the business charts.
Right.
So, there's many of these stories in here. If we can just go through this one from FHC Tattoo, and it goes from 2019, 8,878. Stays pretty close to that till 2022, goes up to 13,000, then 14,000 in 23, 23,000 in 24, and 24,000 in 25. One on the Central Coast, up by $31,000 a year, and ends up with the closing of the tattoo centre. Most of these talk about being in buildings where there's a strata title dimension to it, and your evidence indicates that that is much more problematic because there are so many more players.
Strata is definitely more problematic. You've also, and I feel like you've also got with strata title, you've also got that sort of embedded thing of like, what, I don't know the technical name for it, but it looks like there's kickback arrangements between strata managers and brokers. That seems to be a thing out in the world. And when the price is already so high, I mean, I think there's also, speaking to brokers, there's also a real shortage of people that will even manage strata, that will even insure strata title. So that pool already is like quite limited. The last time I spoke to Shervin from Apex, he was saying there's like seven insurers that will touch strata, like commercial strata, which is a real problem for tattooing or any kind of...
Well, for any business.
For any slightly... That's right, because all of, every bit of development and density, increased density stuff in major cities is going to necessarily have strata involved in it.
So I've got two final questions, if I can. Some of the submitters to this inquiry are referring to evolving workplace risks.
Okay.
You've talked about changing practices and a rationale for a reduction in risk, but there are newer understandings of psychological injuries, and these are factors that have been contributed to increased insurance premiums. How have these factors changed the calculation of risk associated with small business in your experience?
So are we talking like psychological injury claims
Yep.
in relation to tattooing?
Yep.
I haven't heard of any.
Okay.
But is this something that people are saying has occurred in the tattoo industry, or are you
No, just generally in small business that there's been an increasing number of claims and that there have been some significant payouts and that's changing the premium. But that's not your experience.
No, I mean, look, I think there's a culture in the tattoo industry now of just duck and cover when it comes to insurance because it's such a rip-off and no one wants to make a claim. Like, people would rather replace a window or pay for certain things themselves as a tenant rather than go down the road of a claim.
It's cheaper.
It can be cheaper, but it's also just you just don't want to have a claim that then increases your insurance by $4,000 next year.
Forever, yeah.
So, there is this sort of, there's a lot of examples of great landlords that people work with and they have a good relationship, but you can't, that's not policy, that's just...
Good fortune.
Yeah. The psychological side of it, I'd say that hasn't happened, but not that there isn't psychological injury potentially, but it's, you don't see evidence of it. And I would say that people are just steering clear of trying to make claims on anything.
If there are insurance claims in your sector, what are they? What would they be predominantly?
Building repairs.
Huge amounts.
Building repairs. I mean, everyone pays a professional. Everyone pays public liability, professional, medical malpractice sort of indemnity stuff. To my understanding, there's actually never been a claim in Australia on that. And one of the big problems is that as soon as someone comes to you with an issue, your inclination is to try and help, which is an admission of guilt on paper, and then your policy's void anyway. But the outcomes are actually really good. Like, you don't have people suing each other and going to court. I mean, I think there might be a couple of out-of-court settlements, like we're talking, under 5 that I know of ever. But usually what happens is you've got this sort of goodwill relationship where the business tries to come to the party with a solution. I could be wrong, but to my knowledge, there's never actually been a claim on any of these policies for liability. But they're not actually bad value for what they cover you for. So the industry's probably not complaining about that.
Probably.
And there is a degree of competition in there as well, like enough that you can hunt around and get decent value. Yeah.
Okay. If there are no further questions, then can I thank you, Mr. Cairns, for your evidence and representing your guild today. If there are any questions on notice or additional information that you could provide, please give that to the Secretariat by Friday the 29th of May.
Could I ask, were there any other, did you guys have any other sort of speakers from the tattoo industry?
No.
Involved? So there's no others?
No.
Okay.
No, we've got to cover the whole economy, so we'll get you and probably just exclusively you for the whole industry.
Okay. No,
and as the president of the guild,
this stuff too, which is
representative, yeah. So
cool.
we have heard this morning from music publishers,
Okay.
right, which is something you wouldn't think was particularly, but everybody's got insurance.
Oh,
Everybody's got
everyone.
insurance, right?
Yeah.
So, yeah, you're representing your sector.
Okay.
The nightclub boys are going through the same pain you went through a decade ago.
Right. Yeah. The reason I asked, there was a person with an idea who we know made a submission in when you guys were taking the written submissions, touting a thing called InkSafe. And we had met with him, and it didn't look like something that was supported by industry. It sort of offered a solution to a problem that doesn't exist, and most of what it was about was pertaining to risk mitigation around liability. But the industry, from our perspective, it was just adding another layer of admin and cost for no real benefit.
Okay.
That was our position on that. So I was just wondering if that was being presented, but that's...
Well, it's been received as evidence, but we can refer to that, but you've given your view of that now.
Yeah.
That concludes this session, and the committee will now suspend until 3 p.m.
Thanks for your time.
Thank you. And I welcome a representative of Consult Australia, Miss Christine Banks. Let's just confirm that you're with us by teleconference.
Yes, I am.
Wonderful. I understand, Ms Banks, that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full name and the capacity in which you appear today?
So my name is Christine Banks and I'm National Policy Manager with Consult Australia.
Thank you very much. I now invite you to make a short opening statement, and at the conclusion of any remarks, I'll invite members of the committee to ask questions.
Thank you. So Consult Australia is the industry association representing consulting businesses in design, advisory and engineering. Our industry has close to 60,000 businesses, includes many small businesses, about 97%. And these businesses provide technical services across the infrastructure asset lifecycle as part of the supply chain required to deliver government infrastructure priorities. The consulting industry in Australia faces challenges in accessing affordable professional indemnity insurance, and this can be a barrier to small business participation. We do regularly survey our members to collect insights on market conditions, and availability and affordability of PI insurance is consistently raised as a top concern. When it comes to the challenges of running a small business, it is impacted by the client's ethos, procurement capability, variations in contract forms and risk approaches around the country. In some jurisdictions, we can see up to 40 different standard form contracts in a single sector. And the burden on a small business in navigating that landscape is substantial, and the benefit for lawyers in negotiating is questionable. It does not lend itself to productivity or making it easy to do business. For a small business working in a single sector, before you even get to the insurance terms that sit in those contracts, they have to navigate, read and obtain legal advice on each different bespoke contract. Once a position on the contract is formed, they then need to acquire the required insurance. And members report that requests for 20 million PI are becoming more common across government clients. Small businesses are feeling the impact. Examples included in our submission include a 23% premium increase with a 7% rise in fees for 10 million PI, and premiums rising from 60,000 to 250,000 for 3 million PI coverage. So what can be done? Our submission recommends key actions for governments to reduce the barriers to small businesses and their participation. This would be through improving access, affordability and availability of small business insurance by being a model client, which is adopting collaborative and fair contracting as government policy, reforming legislation on contracting out of proportionate liability, unfair contract terms, protections and misleading or deceptive conduct, and undertaking procurement reform to uplift procurement capability, recalibrate insurance obligations and contracts, set a limit on liability, and improve risk assessment and management on projects. Thank you.
Thank you very much, Ms Banks. And I'm going to go directly to Ms Jarrett for some questions.
Thank you. I just want to pick up on your comments in relation to the contractors. Can you walk me through, exactly what you're talking about there in terms of there being, government should be a model client? Like, what are you seeing, and how is that impacting your insurance costs? Because I hear from what you're saying, I mean, there's substantial increases, 60,000 to 250,000 for a $3 million PI insurance coverage is a huge, huge increase, no question about it. So can you help us understand what's going on? Go into that in a bit more depth, please.
Yes, no worries. So when it comes to a model client, what we're talking about is adopting collaborative and fair contracting policies. So we actually outlined some...
What does that mean to start off with?
Okay, so we outlined some model client behaviours in our submission. And when just looking at some of those, so what we see in contracts from government is that we'll see no clear limit on liability, so it'll either be an unlimited liability, or there'll be a limit on liability with significant carve-outs, which means that there is no real limit. And without that limit on liability, that means businesses have no certainty around their risk exposure. So when they go to an insurance provider, having to get insurance coverage, the insurance provider is looking at the contract that they sign up to and whether they are willing to take on the risk in that contract. So if the government contract that they've been given, in this example, has an unlimited liability, the insurer will make an assessment on how much insurance they're willing to provide at what cost. So in an unlimited liability situation, the premium will likely be higher because there is a increased likelihood of the consultant being exposed to a claim.
And as a consultant, I understand exactly what you're saying, but I was more like, I'm trying to really get my head around, I guess, who are we talking multi-million dollar projects, in which case they're not small businesses that are going to be doing them. So I'm just sort of trying to understand, where does the small business piece fit into this world that you're talking about?
Yeah, so the small business piece is that a lot of small businesses in the design and engineering sector provide more specialist niche services. So they may be doing things like quantity surveying, geotechnical work, environmental services, project management, could be in architecture or specific design elements of a project. So often, even on larger projects, you will see subcontracting out down through the supply chain to attain the necessary skill sets. Small businesses are quite regularly engaged for project management services and early investigation work on larger projects as well. And then they also do a lot of work for local government and at council level as well. Yeah.
So how does this compare then in your opinion with how, say, contracts with the private sector are treated? Are they treated any differently, or are they all the same?
I think at the moment, we don't have visibility of private contracts, so a lot of the work that Consult Australia does is in government contracting. What our members anecdotally tell us is that a lot of the terms follow government. So the member perception that's been shared with us is that government kind of sets the benchmark almost when it comes to a contracting point of view, and then some, particularly at local government level, so for councils, but also in some of the private sectors, they will look to what the government contracts have in as clauses and mimic those as appropriate. So that's anecdotal, I suppose, information that I've been given from members in conversations. I haven't actually reviewed any private sector contracts.
And your response to this is better contractual arrangements, or are you really calling for the removal of unlimited liability?
Because Australia does advocate for a limit of liability to be set because it represents good risk process. So when it comes to a contract and undertaking, robust risk assessment and management, that is the process by which government clients and consultants would identify who is best appropriate to carry a risk and to mitigate a risk, and that would drive your limit on liability that was set through a contract.
And where else are you seeing such limited liability? What other sectors? Because you must
sorry, what was that last?
Yeah, because you must have based your thinking off of research that's been done, and you know, examples of what's happening elsewhere?
Yeah. So Consult Australia is a national association, so we do get engaged with government around the country. So we see varying levels of contract conditions, including limit of liability around the country and across sectors. So whether it's transport, health, local government, state development, you know, specialist projects, yeah, defence is another one. So it's we you know, the position that we've formed is informed by our review of contracts across government around Australia, but then also looking to good practice globally. So NEC4 contracts in the UK and FIDIC contracts as well.
And are there certain industries or sectors that lend themselves more to this than others, in your opinion, from what you've looked at? This approach?
I would say no. I would say it's about a baseline of procurement capability and contract management.
Okay.
Yeah.
Okay. Could I just ask you quickly about cybersecurity insurance? Are you seeing seeing that play into insurance costs, not necessarily in PI insurance, but in the clients that you're working with? Are you seeing cybersecurity insurance rate, you know, becoming more prevalent? What's the availability of insurance to you know, to the industry, etc.? And are those costs increasing?
Yeah, I might have to take that question on notice because I would need to check my colleague on that information. Yeah.
Okay, thank you. That's all, Chair, for the moment. Thank you very much. Any questions, Senator Sharma?
I had just a few, if I could. Hello, it's Senator Dave Sharma here. Thank you for that submission. I just I wanted to ask about your suggestion in your submission that claims of misleading or deceptive conduct are often made against your members by much larger, sophisticated businesses that have the benefit of both internal and external legal advice, and your view in that submission that these claims are being used inappropriately as a tool to pressure your members or suppliers. Would you mind just explaining that assertion a little more to me and you know, the sort of scenarios it applies to?
Yes. So that information has come from engagement with members around the claims that they're facing and the information that they've shared with us around those claims, and then also the level of rework and that we see across industry. So a lot of what we've been told by members is that when these misleading and deceptive conduct claims are being brought against them, there isn't the remedy of work or rework is not necessarily following with that, which has led to this conclusion that it's being used inadvertently to pressure them to settle, or, you know, against them by larger businesses. So.
And in what sort of scenarios does that happen? Like, can you just give me an example of when that's been? I mean, you don't have to name the businesses, obviously, but I don't quite understand how it's being used. It's just it's my, not your fault. It's my ignorance of the industry. But I just want to understand.
Yeah, no, it's fine.
What's the scenario where that's come about?
Sorry, I'm just looking up. So the scenario that we're seeing is where there's there might have been a claim brought against a consulting business, and then the misleading or deceptive conduct claim is being added on top of that. So, you know, I don't have the detail on the specific claim that's being brought in the first instance. I'm happy to take that on notice and come back to you. But it usually is a layering of claims, and then the misleading and deceptive conduct claim is being used as kind of the final instrument to push for the settlement.
So is that a claim from another business with which one of your members has had a contractual relationship of some sort? Is that right? So they've provided a service, they've been paid for the service, and then that business is disputing the fee or something like that?
That's it might not necessarily be a fee dispute. It could be around the work. So often consultants are engaged in a design and construct environment. So the constructor has the primary relationship with the government client, and the consultant is engaged by the constructor. If at the end of a project there are claims against between government and constructor, there are cases where they can then slow down the supply chain to consultants and subcontractors below that. Okay. And that's kind of the scenario where we're seeing this misleading or deceptive conduct claims being used.
I see, okay. And how common or otherwise is this? Like, have you heard of 1 or 2 cases, or 5 or 6 from your members? Like, what's the frequency?
Apologies, I don't have that specific information to hand. My colleague who was unable to attend today will. So I can get back.
Take that on notice and just give me an indication of how frequent or how many instances you're aware of from your members.
Yes.
Okay, thank you. Thank you, Chair. That was all.
Thank you very much.
Oh, yeah.
Mr. Buchholz?
I've got another one.
Okay, come back to you, Ms. Jarrett.
Thank you. Can I just ask a quick question in relation to? I'm just trying to understand. Like, these are massive increases in the insurance premiums. Are you seeing changes in, like, big increases in the claims and the payouts of claims? I'm speaking obviously here towards tort reform, because we've heard how that changed things back in the early 2000s. And there have been some submissions that talk to the need potentially for tort reform. Are you seeing that though?
We're not getting information from members on the payouts that they're receiving, more on the premiums that they're paying.
The premiums that they're paying. Okay.
Yeah.
Thank you. Thanks, Chair.
Thank you very much. If I could just ask about the absorption of the rising professional indemnity premiums, do you think that PI is entrenching, the accessibility of PI is entrenching a concentration of larger consultancy firms who are able to afford it? And is there any way to disrupt that in your view?
That is a really good question. What we do see is when it comes to small businesses, they don't go insolvent, so they just shut up shop. So if they can't afford the PI premium, they have to maintain their insurance coverage for 7 years after they last do work, because claims can be brought against them in that time. So if there is a measure of strain that reflects stress in the market when we see small businesses closing down.
Before you continue, can I just reflect on a further previous inquiry of this committee with regard to insolvency, that there are many businesses that are closed that don't declare themselves insolvent, and perhaps they just reshape themselves. How does the 7-year claim process get managed in those circumstances?
So they would maintain their insurance cover. So if the claim is brought against them as a person rather than as an individual, rather than against the business. Yeah.
Okay.
So that's all engineers need to maintain for 7 years.
Regardless. Yeah. Okay.
Yeah. Yeah.
Is that exploited in any way?
Not that I have any information that it is. Yeah.
Okay, great. Please continue
with
your answer.
I can't confirm nor deny.
Yeah. Thank you. Please continue.
But when it comes to absorption into larger businesses, it's likely, it's possible, I should say, but we haven't had any members report that when they've closed their small business, it's to move to a bigger business. So I don't have any evidence that demonstrates that it's the case, but it is. I imagine it would be possible. Yeah.
Okay. Have you undertaken any analysis of whether current PI settings are entrenching what might be described as an effective monopoly or oligopoly in Commonwealth consulting work?
Sorry, I'm just... So the only analysis we have is anecdotal. So that's from members where they've been unable to obtain the required PI levels. They're no longer able to keep operating or take on further work. So in that case, it does create a barrier to small business participation, and you would mean that
so there's no
they are no longer
competition.
part of the supply chain.
Sorry to interrupt you there. So there's no competition analysis, really?
No.
Is there a reason for that?
Just that we haven't had it raised by members as a query that we've looked into yet.
Okay, because it requires a collective response to actually get that data and look at the competition.
Yeah.
So I might just put that to you as probably a piece of work that needs to happen, not just for your members, but in the national interest. I mean, if we're talking about government consultancy work, Commonwealth consultancy work in particular, we need good value for money. Your submission argues that insurance policies are commercial in confidence between the insurer and the insured, and so they can't be shared. But isn't it the case that insurance policies are confidential but not legally undisclosable? And that requiring visibility of exclusions and erosion is a reasonable step where government's trying to protect taxpayers from uninsured liability?
So the insurance policy that businesses take out is a business tool that they use to mitigate their risk and exposure. So they do share a certificate of currency with government if they are engaged, which outlines the coverage that they have, and the excess and may include deductibles depending on what is disclosed.
Right.
But sometimes the insurance provider is actually driving what commercially can be shared there as well.
Right. It strikes me as a little unbalanced that the public good doesn't trump the private interest of insurers who declare what can and can't be shared with government.
The government is getting notice of what insurance coverage the client has. The limit on liability and risk conversation should be happening separate to that. I mean, limit on liability and risk is the core discussion that needs to happen from a public point of view to understand where risks sit, how they are mitigated and how they are covered. The business then decides how they are going to cover their proportion of the risk and liability. So what level of insurance do they require? I think it's one of the things we highlight in our submission that, just by passing the risk on does not mean that the risk is covered. So it really comes down to that robust discussion at the initial contract project setup planning stage around where risks sit and how they are to be mitigated and managed. And by all means, government will ask what PI insurance, the stipulated level of PI insurance, and they'll confirm that the suppliers have that PI insurance. But that there should be controls within the process up to that point that protect the public purse.
Just one question, one final one, if I can. Have you done any assessments of whether high PI limits reflect not just the likelihood of error, but the scale of downstream harm if the advice is wrong?
So if high PI limits protect the scale of downstream harm, is that the question?
Yeah, so PI limits reflect not just the likelihood of error, but actually are related also to the scale of the downstream harm if the advice is wrong.
In my experience, what I've in conversations with government and with members, it depends on the those involved and the project details. Often when the contract is being set, there's varying levels of rigour and detail behind the PI limits that are being set. So a higher PI limit may be chosen just because it's more likely to give you the chance of covering any potential exposure rather than having a evidence or calculation behind it. So I think that's one issue we've seen members reporting, that 20 million is increasingly becoming the standard requested level. There's been no evidence given as to why it's gone from 10 to 20, because it was 10 million probably only 5 years ago. So it does seem to be quite a nominal apportionment and a level that's being set.
Yeah, so it seems pretty arbitrary.
Yeah, that's the word I'm looking for. Thank you.
Arbitrary. And have you sought any information about why that is the case? The 10 lift to 20?
Yeah. So in engaging with government, when we engage with government around insurance levels, we do seek to understand how they are determining the levels. And there's been some positive outcomes where then government develop risk matrices that kind of outline the conditions or profile of the project that then determine what PI limit should be selected. Okay. That definitely means it makes it a less arbitrary process, but that conversation and work is ongoing.
Yep. The other thing I wanted to ask is the cost of 10 million to 20 million. Have you got any information from the insurers about the relative cost allocation? Like, how do they do their sums to come up with the terms of the contract for the increase from 10 to 20?
No, we don't.
Sorry?
No, we don't have any information from insurers on that.
Okay, thank you. Look, can I thank you very much? If there are no further questions, colleagues, can I thank you very much for your evidence from Consult Australia, Ms. Banks, and let you go back to your normal job.
Thank you very much.
Thank you very much. And I invite Representative Dr. Jodie Trembath from the Australian Chamber of Commerce and Industry to step forward to the table. Thank you. Good, how are you? I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you, Dr. Trembath.
Correct.
For the Hansard record, will you please state your full name and the capacity in which you appear today?
Yes, I'm Dr. Jodie Lee Trembath. I am the Director of Skills, Employment and Small Business at the Australian Chamber of Commerce and Industry.
Thank you. And I now invite you to make a short opening statement.
Thank you.
And at the conclusion of any remarks, I will invite members of the committee to ask questions.
Wonderful, thank you. And thank you to the committee for the opportunity to appear today and speak about small businesses, which is one of my great passions. I'd like you to use my opening statement to do two things. Briefly, set out the operating environment that small businesses are operating under, and then speak to three specific issues that are directly relevant to this inquiry. So those are, first, the burden that state and territory taxes and levies place on small business insurance. Second, the way that insurance requirements in procurement and contracting are often designed actually for larger businesses, but end up being applied to smaller businesses. And third, the growing misalignment between conditions on the ground in Australia and the way that international reinsurers assess that risk. So let me start with a short snapshot of the small business environment. There are around 2.6 million small businesses in Australia. They make up about 97% of all businesses. They employ more than 5 million people. So that's nearly 40% of the Australian workforce. And they generate around a third of GDP. Australia is fundamentally a small business economy, which means that when small businesses are under pressure, the consequences are felt well beyond the individual businesses themselves. Now, ACCI's 2025 Small Business Conditions Survey showed that overall cost pressures are now the #1 concern for small businesses, overtaking regulatory burden for the first time in several years. Owners are dealing with the same cost of living pressures that all Australians are facing, but they get the double whammy because they're also dealing with it in response to their own livelihoods. And that combination is really becoming unsustainable for many small businesses. 28% of respondents told us, and this should be alarming, that they had considered closing or leaving their business in the past year. And 30% are worried that they may have to do that in the next 12 months. For context, this was done last year. That means that we're looking at that now, and in the interim, we're experiencing a fuel crisis. 44% of small business owners report high or extreme levels of stress. Just think about that for a moment. And the stories behind these figures are real. So last week I was talking to a woman whose family has owned a small manufacturing business in the defence industry for the last 70 years. And she's devastated because now, under her watch, she couldn't afford to keep the doors open. There's still demand for the widgets that she manufactures, but her operating costs have increased and the market can't bear for her to increase her prices any further. And so she just has nowhere to move. And so she's now closed. Even worse, she was one of the only domestic manufacturers making that widget. And so we've also significantly reduced our sovereign capability by her losing that business. So you bring all those issues together: a cost of doing business crisis, high regulatory burden, high levels of stress, business closures, and it's in that context that insurance costs have become one of the most acute pressure points for small businesses. Insurance is consistently identified across all of our chambers in every state and territory as one of the top 5 cost categories for small businesses. In our 2025 survey, more than 1 in 5 businesses responded to rising premiums by increasing their insurance excesses. So that keeps them nominally insured, but in practice shifts more risk back onto the business. In effect, it's a form of underinsurance. Now, we don't have a single national figure for how many small businesses have dropped insurance cover altogether at this point that I'm aware of. But there are some really clear warning signs. For example, following the 2019 Townsville floods, around 40% of businesses didn't hold flood cover. That had huge implications for the recovery, both of Townsville, but also for many of those businesses who couldn't recover and who had to let their businesses go. Our survey also found that 71% of sole traders don't hold cyber insurance, or at least they didn't 12 months ago, despite growing exposure to digital risks, including things like the fact that so many small sole traders work from home, and the rules for working from home around insurance are actually different. At the same time, though, the risks insurance is meant to manage are also increasing. Extreme weather events are becoming more frequent and severe. Since 2010, natural disasters have generated more than $34 billion in insurance claims, with insured losses averaging $4.5 billion per year over the past 5 years. And this is a significant increase on earlier periods. These pressures are felt most acutely by regional and remote businesses, where insurance affordability and availability are increasingly constrained. In northern Western Australia, for example, average small business property premiums exceeded $6,200 in 2023. Risk is also changing in less visible ways. Increased digitalisation and e-commerce have heightened exposure to cyber threats, with the Australian Cybersecurity Centre estimating the average cost of a cyber incident for a small business at $49,600. That, again, is not something they will always be able to recover from. So against that backdrop, 3 system-level issues matter the most from the Australian Chamber of Commerce and Industry's perspective. First, the taxes and levies that are imposed by states and territories materially inflate insurance premiums for small businesses, and that discourages adequate cover and encourages that underinsurance that we are seeing. Second, insurance requirements embedded in procurement and licensing and contracting processes are often calibrated for large enterprises, but they end up being passed on down the supply chain to smaller firms, creating cost and access barriers that have little relationship to actual risk on projects. And then third, global reinsurance pricing increasingly reflects high-level international risk assessments that don't always capture local Australian conditions, or mitigation efforts, or regulatory settings, particularly in regional and high-risk industries. And this is frustrating for small businesses, senators, because they often invest in risk mitigation, but they don't end up seeing that effort reflected in their premiums. And this isn't because local insurers ignore mitigation. It's because pricing is heavily influenced by global reinsurance terms that are set offshore and based on aggregated risk models rather than on individual business behaviour. ACCI's submission to this inquiry argues that improving affordability and availability of insurance for small businesses requires proportionate and nationally coordinated settings that reflect the realities of small business operations. We recommend aligning insurance requirements with actual risk, reforming and indeed removing state and territory taxes and levies, and strengthening engagement with global reinsurers, and investing in insurance literacy and innovation for small businesses. Insurance is not just a protection against loss. For small businesses, it is essential economic infrastructure. It enables small businesses to innovate. In fact, often it enables them to survive. When insurance becomes unaffordable or unusable or even unavailable, it constrains growth, it limits participation in markets, and it weakens community resilience. Thank you, Chair. I welcome the question.
Can I just ask one before I go to Senator Sharma?
Certainly can.
This is not the first inquiry at which I've taken evidence from a witness in good faith about the removal of taxes and levies at state level, but we do have states and they do need income to provide the goods and services that allow businesses to function.
They do.
I'm sure you've made the request in good faith, but what is the scale of taxes and levies at states? What sort of sum are we talking about?
It's significant, and certainly the New South Wales has the highest levels of because they have the emergency services levy, in addition to the obviously GST and stamp duty. So they're looking at about 30%. Now they are currently undertaking reform measures that we hope and they hope will reduce those taxes and those levies. At the moment, though, the small businesses that are being surveyed by ourselves and by Business New South Wales, they're not seeing those effects yet because the reform process isn't finished. So those taxes and levies are still in place. And so for those businesses, the increases that they have seen over the last couple of years have been in the thousands of dollars. And that
thereby there's a windfall benefit to the states.
That's absolutely true. And it will be, it will need to be a negotiation for sure, because you're right, why would state and territory governments want to just give that up? There's no reason that they would want to, except...
Well, how would businesses benefit from an erosion of the provision of like roads on which businesses have to drive? So there's a very connected relationship between those. It's not business versus government. It's about a bearable cost with regard to taxes, levies at state. Could you actually, on notice, provide the quantum of taxes and then separately levies and any other additional costs at state that you're referring to?
So
on notice, I don't need you to do it straight away because it's a fundamental part of your argument, and I think we need to put some real shape and form around that. We're not in a position to do anything about that as a federal inquiry, but it's often the thing that's easily identified but very difficult to do anything about, and there's a reason, which I think I've already indicated, there's a reason for why those taxes are there. So if you can give us the scale of that, that would be helpful.
I can certainly try some.
And the other matter was the reinsurance.
Yes.
Can you talk, how much are you aware of what's going on with Lloyd's as the reinsurer? Do you have any interactions directly?
Not directly.
Have you made any submissions to Lloyd's as the primary reinsurer in this space?
I'm aware that the federal government is making those entreaties to various different global reinsurers yourselves. I realise that's been going on for several years. I know it's been very difficult, and that it, at this point, to the best of my knowledge, hasn't been landing, and that I assume is going to continue, and the importance of those conversations can't be understated.
Yeah, we've had some very interesting evidence already today about Lloyd's from surprisingly from a tattooist guild, talking about different entries into Lloyd's through different brokers, and a differentiation in price of $16,000 down to $6,000 or $7,000. So Lloyd's seems to be quite central to what's going on. So if you could take on notice any action by ACCI, given the scope that you have, in approaching Lloyd's about this failure to reflect Australian mitigation practices versus international aggregated risk assessments that they use for their pricing. On notice, that'd be great. Thank you. Over to you, Mr. Sharma.
Thank you. I did want to pick up on the tax point because it's also subject a point I've heard raised often. As I understand it, and I think you made this clear in your evidence, it's Dr. Turnbuff, isn't it? Yeah. So New South Wales has a higher taxing regime on insurance products than any other state or territory, right?
That's right.
And that's because they collect their emergency services levy through insurance policies, whereas other states and jurisdictions, how do they fund their emergency services?
So they have actually, most of the states and territories did actually have an emergency services levy on insurance, and have reduced those, to the best of my knowledge, over time, and to the extent that now New South Wales is the only remaining state that does, and they are looking to change it. So there are a range across the different states and territories of how emergency services are funded through municipal rates is one of the ways, and that is certainly a logical way to do it. And of course, nobody's suggesting that it isn't important that we fund the emergency services, especially considering the fact that this is an environment where we're seeing increasing extreme weather events and natural disasters. But for small businesses to be bearing such a large burden of the outcomes of that, it just isn't the right set of levers, in ACCI's opinion. Because I actually agree with you, Senator O'Neill, in what you were saying before about this isn't business versus insurers, it's not business versus government. Actually, we're all part of a system. It's a system that's changing, and it's changing rapidly in ways that we're not necessarily keeping up with yet. And so when we're looking at those insurance levers, it's a matter of saying, okay, where are the balance points? Have we still got them right? And I realise that's exactly what you're doing in this inquiry. And ACCI would say no, that the levers aren't currently appropriately balanced.
Because, yeah, as I understand it, the other states and territories collect revenue and from basically property-based levies, so either council rates or land tax or anything else. It's a little like, we don't collect a Medicare levy from business insurance policies. For instance, we collect a Medicare levy through personal income tax because we think that's where the cost is best borne. And I think other states and territories, aside from New South Wales, have decided that emergency services levies are best linked to property owners, which I think is a reasonable conclusion. What does the fact that New South Wales still has insurance-based emergency services levies, what does that add on average to an insurance policy in New South Wales in percentage points?
So I understand that the Insurance Council of Australia is coming to see you tomorrow. I think they will have those numbers for you. I must say I'm not an insurance expert.
No, fair enough.
But I am fairly confident that they have those numbers.
Yeah, I mean, my understanding is that the set of New South Wales policies, so stamp duty at 9%, insurance levy at about 10 to 15, emergency service levy at about 10 to 15%, and then GST on top of that means you're paying about 30%, which is the figure you used in your opening remarks. Okay. Now, as I understand it, New South Wales has actually committed to abolishing the emergency services levy.
They've committed to reform, which is not the same thing, as you say.
Yeah, okay. I thought they committed to phasing it out. I'm just looking at the details I have is in November 2023. They said they were going to phase it out, but they have not done that yet. They announced it on the 16th of November. I've got it written here as a commitment. The press release says that they're actually going to abolish the ESL. But what have they been doing for the last 2.5 years since they announced its abolition? Do you know?
I'm afraid you'd have to ask them. Sorry, Senator.
Okay, I guess the Insurance Council is probably the right person
might
to ask on this. Okay. All right, that was all I had for now, thank you. I know my colleague, I think, has some questions.
Whatever the order is.
Oh, okay. Chair, I'm...
Yep, I'll go to Ms Jarrett and then come straight back to you, Mr Buchholz.
Hi there, thank you for being here today. I just wanted to ask, so there's some big increases that you're talking, large numbers in terms of the impact on small business.
Yeah.
But do you have any insight? Do you collect the data on, what insurance is it that's going up? Because there's lots of different levels of different types of insurance that small businesses need, depending on their sector, but there are some consistencies across the board. So are you seeing any areas where the insurance is going up? Is it PI? Is it, building insurance? Is it cyber insurance, etc.? So your thoughts on that to start off with. And in terms of the increases, do you have specific data on that as well that you could share on notice potentially?
I will take that second question on notice,
Yeah.
if that's okay. Thank you. So in terms of areas where we're seeing increases, you're right, it is diverse. So you mentioned the construction industry, and absolutely the insurance is related to licenses and to workers' compensation as well, and public
And why do you
liability.
think, what's driving that, do you think?
Well, I think there's a combination of factors. So some of it is the fact that we are seeing global supply chain disruptions, and so the ability to finish jobs is not always possible. We're seeing, and this is not just in construction, this is across the board, we're seeing significant increases in psychosocial hazard claims and the need for mental health insurance. And so that is definitely increasing. When we are seeing natural disasters and emergencies that are likely to require repairs through the construction industry, going back to the construction industry, for those circumstances, the environment becomes more hazardous for employees at the same time that that it becomes more hazardous for the businesses or homes or infrastructure that's been damaged. And so
does that actually get reflected that quickly in insurance claims, does it? I mean, insurance costs. Like, could I see my insurance costs go up immediately if I was subject to flooding? I wouldn't, right? It would be next time around. Yeah.
I wouldn't say that. That's so I don't think it's a case of immediately for any of these things. I think there are trends that are leading to further trends. In terms of, so sorry, maybe I misunderstood your question.
No, just some other sectors that where you're seeing the most increases.
So tourism is very problematic, and the problem with that, of course, is that a lot of tourism businesses are located in regional and rural areas where quite often they can't actually get insurance, so they just actually can't find anybody who's willing to insure them, which is really problematic.
And is that because of natural disasters?
Because of natural disasters, largely, and the pool, I'm so sorry, I've forgotten the name of the pool, but the federal government's insurance pool has been, thank you, yes, has been very important in that space, but it's location specific, and for where it has been effective, it could definitely be expanded. So, but it wouldn't be necessary if it was still possible to be able to get insurance in those kinds of spaces, right? So, so yeah, for tourism, it's been really problematic, and particularly for things like caravan parks or adventure parks with rides. If you can't get insurance, then it gets to a point where you really have to start questioning whether or not you want to continue in business. And if you don't continue in business, then, you know, the Thrive 2030 plan for Australia's tourism uplift is looking for $230 billion by 2030, right, for that industry. Well, if we start losing all of our tourism operators in regional areas, then that just can't happen. That's impossible. So tourism is a big problem. We are also seeing, and that covers hospitality and accommodation as well. So those are really critical areas, and probably, yeah, construction and tourism are the two that we hear about the most.
Yeah. Are there sectors that you're aware of where you're not seeing these big increases, like that are just, I hate to use the word, you know, status quo, but are there sectors in your world that are status quo still?
Not that we've seen in our surveys.
Okay.
And I think the reason for that is probably because almost all businesses, not all, but almost all businesses in Australia now are online. And so when you then turn to the need for cyber insurance and the risks of both being online and also the increasing risks from AI, every business has that change. I think, as I said before, also we're seeing increases in claims on psychosocial hazards. Most small businesses have humans involved, at least one. And so for those who have employees, that's an increasing risk as well. So it's not just the weather events, it's also these other kinds of risks that are new. And of course, psychosocial hazards aren't new, but awareness around mental health issues is increasing, and the capacity to claim on that is also relatively new. So those changing factors are really important in what we're seeing in our survey results.
Can I just circle back on cyber? Sure. We heard evidence earlier that cyber's, not a huge number of businesses are taking up cyber insurance, and those that are, there has not been a huge increase at the moment because the market is quite competitive. Would that be your take on it at this point in time?
Yeah, so as I think I said in my opening remarks, we see about, for sole traders, 70% at this time last year, where we're just doing our new survey now, didn't have cyber insurance. On average, it sits at about the 30%, I think it's 31% mark. And so while I think that we will see a shift in those numbers this year, particularly because of the changes in AI, that has really significant implications because the cost of cyber, you know, hacks and other kind of cyber crime is very high and sometimes irreparable for businesses, but it also has a huge cost on the economy, and so yeah, it's a really significant concern.
Yeah, because to me the exposure by having so few businesses being insured in that space is a huge liability in of itself.
Yeah, so we've actually recommended to small businesses to package where they can their different business insurances, which can help to get them a reduced premium because of the package nature of it, and that therefore usually builds cyber insurance in. Of course, different businesses across different industries have different requirements within their cyber insurance based on their risk, and so that's really important as well. I think having insurance brokers involved really helps with this, because having an expert involved really makes a big difference.
Deputy Chair, one more question, if that's okay.
Of course, yeah.
And I just, you actually just touched on what I was going to ask about was packaging of so insurance packaging for small businesses. Are you hearing from your members that the availability of appropriate packaging for them is appropriate, or is it, this is it, you've got to buy it, or are they actually able to get a product that works for them?
I haven't got direct information about that, I apologise, but what we are hearing is that there is a need for increased innovation across insurance offerings and products, and so while that doesn't answer your question directly, I think it probably speaks to
What do they mean by, what do you mean by innovation, or what do your members mean by more innovation?
I think what they're looking at is different ways to offer protections that, particularly I think in the cyberspace, but also in other spaces, that obviously haven't been tried before and are going to give the business, I guess, the balance between a reduced premium and the highest amount of protection. But in terms of details, I'm happy to take it on notice, or you can again speak to ICA tomorrow, because this is something I know that they're
focused on as well. Okay, thank you. Thank you, Deputy Chair.
I'm just stepping in whilst the Chair's absent. We'll go to Mr Buckholz, and then I know Ms Lawrence is on the line. We'll come to her next for questions. So,
great.
Thank you very much for your evidence. Can I say how heightened I am about what you've shared with us today, given that prior to entering politics, I was a small business owner in the transport sector. And so I completely understand, and you have my sympathies as the cost that you outlined. So I take on board the 97% of your businesses make up our economy, which is a third of GDP and 5 million people. That's an enormous amount. The overall cost pressure in your survey, as you said, is number one, and that 44% are experiencing high levels of stress.
That's right.
My question is, you also mentioned that the insurance is in the top 5 line items, and collectively we're looking for ways to support business. This inquiry is about insurance. But for the benefit of us having a glimpse into your surveys, what are the other 4 in the top 5 pressures that you've collected?
So in the national survey, we have, cost of doing business is at the number 1. We have rent and utilities. We have wages and what have I missed? Rent, utilities, wages, and input costs. So the literal, the material that goes in order to produce the products. Yes, exactly.
Cost of goods. How does that differ to cost of business?
So cost of business is things like, for example, 60% of small businesses are spending more than $20,000 a year on dealing with compliance. It's things like managing your involvement with the ATO. It may include, for example, cost of software that you might need. It's
energy?
Yes, actually, I think we had energy in with utilities. So this year for the survey, we have actually separated energy under the current circumstances so that we can see how that's differing. But last year, unfortunately, we didn't.
Okay. Recently, I caught up with a guy. You spoke about your member with the construction of the widgets. I was speaking to a guy the other day who built widgets, and he was near in tears that he was being forced if he was to continue to make widgets, that he needed to take them offshore.
Yeah.
Are you seeing much of that, or would that be a one-off situation?
It's certainly not one-off, and it's in terms of insurance, it's not that so much. But we are definitely seeing that across the board, because costs are so high, that small businesses are looking for any opportunity to stay in business, and it's just a fact that it is often cheaper to outsource some of your costings, especially if you're in the innovation space. So if you are trying to innovate, then chances are it's easier to go offshore to produce your new widget, as you say, then it's going to be to try and get it up here. We have the R&D tax incentive, but it's quite complicated to use, and so if a business is willing to invest in a broker or a consultant to help them apply, then they may get across the R&D tax incentive, but a lot of the time it's just easier to go offshore.
Do you, with reference to pertaining to the compliance cost,
Yeah.
do you, as a Australian Chamber of Commerce, do you work with working up submissions to government to reduce compliance requests?
Absolutely.
Yeah, good. Regularly? How do they give you green shoots? Do you see any outcomes from that?
I think that there has been movement. Certainly, we're interested to. We were very excited that the Treasurer talked about productivity in his post-election speech, and the Economic Reform Roundtable, I think, still has potential to have movement. We're seeing some shifts, I think, in the way that red tape is being talked about. What's going to be really important, though, is that a couple of things. Firstly, it can't just be reducing red tape for the public service. It can't just be about making things easier for the public service to process, because while that will help, it doesn't help on the ground for small businesses in an immediate sense. So that's something that is going to be critical. We're also really keen to see that those duplications that are happening across federal and state, it's a really challenging thing to do. Everything about federation is challenging, right? But that is one of the things we hear most commonly from small businesses, that why is it that, another small business owner I was speaking to recently, it was another woman. I run a women in small business program, so a lot of these examples will come from women. So she had, indeed, thank you, I agree. So she had gone to whatever the state vehicle registration place was in the state that she was in, and wanted to change over some registration details for one of her work vehicles. And when she got in there, they said, actually, what we don't have from this is something at the federal level. And she said, but I've lodged that at the federal level when I did this a couple of years ago. And they're like, yes, but the regulations have changed since then, and now we don't have access to that system anymore, and so we're going to have to get you to do it again. And she didn't have that with her. So she had spent, this is in a regional area, she had spent quite a long time driving to that location just to do something really simple that she wasn't able to do online for reasons that are unclear. And then when she got there, because the regulations had changed, she wasn't able to do it. So that's, an hour and a half of her day where she wasn't making any money, she wasn't doing anything productive, because she was dealing with red tape that, if those systems talked to each other, which I realise is expensive, but nonetheless, in terms of investment in long-term productivity, that's one of the things that would make a big difference.
Thank you. Thanks, Chair.
Thank you. That was a really interesting piece of evidence, because I think red tape is conceived of as one thing, but you've just described a tech process that I don't think would commonly be called red tape. It's a technological investment failure or a communication breakdown between the state and federal government. I just wonder how much AI might be able to begin to identify and diagnose those challenges in an efficient way, because the productivity hit for everybody when they interact with any government system that they're unaware of, whether they're a pensioner trying to negotiate why they just got their pension stopped, or whether it's a business trying to shift the registration of a vehicle and there's something changed since they last did it. There is a cost to the individual, the citizen, regardless of whether they're a business owner or not. So I think that's a very interesting observation for me as what's a concept of what red tape is. And usually these regulatory changes because somebody's done something wrong. So there usually is a reason for it. It's not just to make business harder. So I think that's a very, very interesting piece of evidence.
The line of questioning was to try and tease out where are some of the other places other than the insurance council, because they're going to come on the GST. So if that's something that is beyond us, why don't we investigate what are the other top 4 cost pressures from a fiscal perspective and pull those levers to offer the assistance to, because I think in your opening comments I do have a high expectation that insolvency rates will be through the roof, and that aligns with your prediction of 30% looking to leave the industry.
That's right, yes. And so 2 things there. If it's at all helpful, I'm more than happy to forward you our small business conditions survey from last year, and then as soon as we get the results through for this year, also happy to send those through.
Happy to receive them.
Excellent.
I know that we have the senators and members here before you, but we also have Miss Tanya Lawrence from Western Australia with us.
Lovely.
And she has indicated that she has some questions. So I'll go to Miss Lawrence now.
Lovely. Thank you very much. And my apologies, I'm in person. Just going to your submission, I'm just interested to just unpack a little more around the recommendations. So recommendation 1, you have noted as part of a broader tax reform, taxes should be abolished or reduced, and that the reduction in insurance tax would address the underinsurance problem and build business confidence in undertaking economic activities. The chair at the opening did request some information on notice in relation to taxes, and I just wonder if you're not in a position to answer now, whether you could also include an analysis as to how premiums differ across the jurisdictions where the taxes are lower. So, for example, in Western Australia, the emergency services levy is attached to property, not to the insurance. So how has that reduced premiums for businesses in Western Australia, as an example?
Can I just try and repeat that question back to you and make sure I captured it? Apologies, you're just cutting out a little bit, but let me see if I got it. Is it essentially that I am looking at how removing the emergency services levy has reduced premiums in WA?
That was an example, because your recommendation states reducing taxes would address underinsurance and build business confidence. So I'm just trying to get an assessment where the taxes are lower in a given jurisdiction. What effect has that had on business and their access to purchasing insurance products and building confidence? So just trying to get the evidence, I guess, to back in the claim that abolishing, reducing taxes would have the desired effect.
Yeah, okay. So I think what that would require would be and I don't know if this data is available, but I think it would require being able to identify with the other states as they have abolished their emergency services levies, for example, data from before and after. So some of our state and territory chambers might have that, and I can certainly reach out to them and ask to see if I can get that data. Every state and territory runs a similar to our small business conditions survey under different names. So let me see if I can find kind of those crucial index points where before and after, and we can see whether business conditions and business confidence specifically has changed. What I would say is that when we have seen changes to insurance systems, and this isn't a direct answer to your question, but for example, in the 2000s when we saw tort reform around civil liability, we did see significant increases, I believe, in business confidence because premiums did go down after that. So I have now told you the extent of my knowledge of that time, but if there's anything else that you wanted to know, then I'm more than happy to find out. But I do think that that is possibly indicative of the fact that when we do put these measures in place that reduce premiums, they do have positive outcomes on business confidence.
Even if there can be some analysis, like in New South Wales, if ESL is still on the insurance premium in a given sector, how that compares to the same sector, say in Western Australia where it's not paid. Like, are the premiums comparatively the same, or is it significantly, like, by that same percentage cheaper in WA? Like, it's just trying to get a sense of the demonstrating that removing the tax doesn't lead to creep in premium pricing, so it's back to where it was before. Like, if there's an actual reduction or an increase in take-up of products that are needed to cover a given business. So I'm just looking for data around that if you're able to attach it. And the other thing, I guess, just as an observation, and I appreciate your submission is really succinct and which is desirable, to be honest, and helpful. But one thing I thought was a little bit glaring in its omission was the lack of reference to competition. And I just wondered whether you had any remarks around that, whether you didn't see competition in the market as a barrier to, lower pricing, access to, products that are suitable, fit for purpose, like just any remarks around competition?
Do you mean competition between the insurers?
Correct.
Right, okay. So I think that for us, this isn't something that we have looked into because we are specifically looking at small business experience. And so it isn't something that has come up between members. They haven't talked about there not being enough competitiveness between insurers. So anecdotally, I haven't got anything to add. It's not something that we've asked as a question in our survey, but I'm also not sure what we would ask in that context either. I guess the question could be something like, how do you choose your insurance products? But it's a very broad survey covering many, many topics. So we only have a couple of questions in there around insurance.
Okay. And then I just had one more around, I'm just looking for your recommendation. It was, I think it might have been an actual sentence there. Oh, yeah, this relates to small versus the larger, more complex organisations that as a proportion are paying less than small businesses. So I'm just curious as to, I know you're suggesting better alignment of regulation would set better parameters for small business. But I'm just wondering how you would envisage that working, where if a small business is, say, in the recreation sector, taking tourists abseiling or something of that like, how would the insurance price that to be commensurate with the fact that they're a small business with a small turnover versus a larger, enterprise that might be able to employ additional people to manage different risks, have additional safeguards and so forth. So just wondered whether you had any view as to how you would think it would work in practice to create a tiering within business sizing to be the premiums were commensurate with the size of the business, because that's kind of how I was reading it, where you're advocating that small business is paying more than a larger, more complex organisation. But I'm not sure that the risk is different. So I just wanted any perspective on this to help me understand your point of view.
So are we talking about the section on per $1 million of income? Sorry?
Yeah.
Okay. So basically what we're looking at there is the ability for large businesses to be able to negotiate their premiums differently to small businesses out of their size, and because they have the in-house expertise to be able to have those conversations. So it's not so much risk-based, it's more about and this is obviously the case across lots of different areas. We've had this same conversation recently around merchant card payments, that large businesses can negotiate better prices with the card payment systems than small businesses can. So it's the same kind of principle. So it's not so much about risk. If a small business tourist operator was taking people out sailing and it was a small business rather than, say, some large kind of cruise situation, perhaps, then my understanding is that the reason that the cruise ship would have a better likelihood of having better premiums is because they are more equipped to be able to negotiate those prices and negotiate deals.
Okay, and so outside of education, which can be done within the market itself, what intervention would you, or role of government do you think there is in that space then?
That's a very good question.
If any.
I want to, the previous question, I want to make sure that I've got that right for you. So if I might provide additional information on that question on notice to make sure that I have gotten it accurate. In terms of what government intervention we'd be looking at there, I think that this largely comes back to the reinsurance perspective, because again, we're seeing that the reinsurers are in a position where they aren't seeing what's happening on the ground. So I think the intervention there continues to be government talking to those reinsurers, education and negotiation on behalf of, I guess, all Australians, but specifically businesses and insurers, so that understanding sits at that global level differently than it does now, which will then come down to that local operator in Darwin who's taking a person out on a sailboat.
Thanks, Chair. Thank you.
Thank you very much. Can I just go to one of the questions we've been asking through the course of the day with regards to the impact of psychosocial claims in the workplace? I'm a Labor senator, and there's often a misapprehension that you don't understand small business, but I grew up in a small business family, and I've never seen a day where there wasn't pressure in small business, frankly. But this number of 44% at an extreme level of stress, what do you think, what does ACCI think the outworkings of that will be in terms of increased psychosocial claims and the impact on insurance?
It's a very interesting question. So I certainly worry about it, which is not the same thing as providing you with facts. I think what we're seeing in terms of outputs in that space is we are seeing increased closures we're seeing lower job satisfaction, which we think, and I don't want to overstate this because I don't have evidence to put behind it right this minute, but we think that it's reducing innovation, essentially because it's hard to think about doing new things when you can't keep up with doing the day-to-day things. And that, I mean, the results came out this week, didn't they, of Australia being, it was somewhere in the 70s for economic complexity. Does anybody remember that article this week? Apparently we're somewhere in the 70s for economic complexity now, which is obviously not great in terms of a ranking against other countries. And innovation's critical for economic complexity. So given that we are a small business economy, 97%, we need our small businesses actually to be diversifying, to be across lots of different industries. As BEFIO, the Small Business and Family Enterprise Ombudsman, often talks about, we are sleepwalking into a large business economy because the more regulation we have, the more businesses that close due to stress or not being able to keep the doors open logistically, the less diversity we'll have across the economy. So those are my concerns, certainly. And I think in terms of...
Do you have any data on regulatory burden and the closure of businesses? Because it's often stated, but I haven't seen anything that actually clearly indicates a causal link. I mean, regulation and regulatory change is a necessity of human life for everybody, whether they're in business or not, right? Things change constantly. So if you could take that on notice and find any sort of causal links, that would be good.
We do ask that question in the small business insurance, like how much is...
But self-attribution is one
is
thing
100%.
by comparison to a causal link that's independently observed.
Absolutely. But I don't know that... I think you're right. I don't know that there is any data on that, but I'm happy to have a look.
Right, because it's so often stated. I just think we need to question it. The other thing is, in terms of the small business sector, I have read over the years that there's an increasing ageing profile in our small business sector that is perhaps not as digitally native as younger people. Is there any data that ACCI has about the challenge of technological change that's linked in with this stress data? But if you could find anything on that, that would be helpful. But my key question is, if there is insurance to cover for psychosocial challenges and 44% are talking about being in an extreme level of stress.
High and extreme.
Yeah, what does that mean for premiums going forward? So if you can take that on notice, that would be really good.
Sure.
Do you represent any insurers?
Yes.
Who?
We represent IAG.
Yep.
I think you're speaking to them tomorrow. We also represent the Insurance Council of Australia, which is how I know that when you are speaking with them tomorrow, that they'll be happy to take your questions that I can't answer.
Okay, thank you very much. Do you represent any brokers?
No.
Okay. Is there any reason for that?
Not that I'm aware of.
Okay. In evidence we received this morning from Finity Consulting, there's a fair bit of data that I'd be very interested to get your views on, if you could have a look at that after this hearing. But they talked about market hotspots, and some of these would absolutely involve small businesses. They talked about music venues, softening of standalone liability market. Certain exposures remain hard to place. That's one of them, music ventures. Also talked about scaffolding. And I heard that you mentioned, construction.
Construction
as well.
scaffolding, yes, certainly.
So what data does ACCI have about hotspots such as trade contracting, music venues, parks, active recreation, agricultural chemicals, scaffolding? Have you got any data about these hotspots? What are your members telling you about what's happened there? Because it looks like the market's just like they've just taken the product away.
Yeah, and certainly the live music and live entertainment is a huge problem, and so we do represent those industries. I can have a chat to some members about that for you. In terms of broadly, though, what kind of data we have, so we segment our small business conditions survey by industry. And so we can look at those questions based on specific industries. I can't go down to the level of scaffolding, but certainly I can have a look at construction versus arts recreation.
Yeah, so if some of the construction companies could provide you with an understanding of like what happened with regard to scaffolding, like why is it so difficult for them to manage that exposure there?
I'm sure the Housing Industry Association would have answers to something like that.
Has ACCI approached IAG on behalf of other members to interrogate their practices?
We talk to all of our members regularly, including IAG, and actually the work that they are doing, this sounds like I'm just saying this because they're my member, but honestly, like I've been really impressed. The work that they are doing to try and make things better for their customers is actually really impressive. The changes that they've put in place through technology, for example, when there were issues with it taking too long for them to be able to respond to claims because there were too many things happening at once, they put together a national 24/7 crisis centre that like there's always somebody there, and then they've got task forces that are ready to be like, brought in at a moment's notice. Like it's actually, I mean, I think you're talking to them tomorrow, so I won't, I don't want to steal their thunder of their stories, but I've genuinely been impressed with the changes that they are making because they are trying to shift the dial already on how they serve their customers.
Have you got the opportunity to have IAG respond to other members of your organisation or your association to explain the challenges that they're facing?
If my members requested to have a conversation with IAG, I could certainly arrange that, but nobody has asked for that at this point.
Okay. And I guess this goes to another question, that your submission recommends that the government should align insurance requirements for regulation and procurement to the actual risk of activities. My question is, why does ACCI consider this alignment task to be one that requires government intervention rather than being addressed through market-led underwriting practices or private contracting arrangements?
So this is part of a suite of issues around white tape. Is that a term that the panel's familiar with?
We haven't
heard that one before.
Yeah.
Yes. Oh, well.
Less colourful.
They're all bad. Yes, that's right. So, and put them together and you get pink. But essentially white tape is where government is regulating large businesses, and large businesses, in order to comply with government regulations, pass on those regulations to small businesses that those regulations don't apply to, and they are exempt from. But in order to be able to work with a large business as a contractor, the larger business must be able to, they must impose it because they have to be able to demonstrate to government that they are meeting those compliance areas themselves. So the probably the most common example that we talk about is the modern slavery.
So you can't absolve yourself of responsibility because you're further up the food chain.
Yes.
You have to make sure all your suppliers are...
Yes, okay. Even though small businesses are exempt. So what that looks like in the insurance space is that large businesses are required by government to have a certain set of insurances and a certain level of coverage and an amount of coverage. And then those larger businesses pass that on to smaller businesses to say, well, you need to show that you also have those large amounts of coverage available, because we all have to be able to do that. Similarly, if that small business goes for a government contract, then they have to be able to demonstrate to government straight away that they have, because they're not going to be exempt under those circumstances. So what we end up seeing is that a lot of the time small businesses are essentially excluded from being able to go for those kinds of contracts because they can't afford to buy that level of insurance, especially because the part of the project that they're working on doesn't have the same degree of risk as the large company that is, looking at much broader and much more complex considerations within the project, and therefore they do need to be able to show that they have the insurances to cover multi-millions of dollars, but the small contractor doesn't actually need that. So we're just asking for the risk profile of specific small business providers be assessed independently of the larger projects.
Okay, and I understand that you're saying that with regard to government projects, but there's a lot of money moving around in the community that's absolutely not government money.
Yes.
And with businesses, we heard from the tattooists a little earlier, and they need market-led underwriting practices to be interrogated, and it's got nothing to do with government. So I guess the question is, what pressure is ACCI bringing as a representative for all of those businesses? In matters that are not related to government. What pressure are you putting yourselves on insurers? Like, what are you telling them? You've come to tell us a story. Have you been telling insurers about these problems as well, and what submissions have you made to them, and what's their response?
So we don't make submissions to insurers as such, but we certainly have lots of conversations with ICA, with the insurers that we represent, and they're very aware of the issues. There's nothing that I can tell them that they're not going to be aware of. They are doing their own conversations with small business owners and with large business owners all the time. I am part of the Insurance Council's small business, I can't remember what they call it, advisory group, I think it is, which has myself as a peak body representative, but it also has a series of small businesses, has the brokers, it has, I think, COSBOA's on that. So they're doing those things already. It's not a matter of them not being aware of the issues.
I guess being aware of the issues is one thing, but like, where is the pressure from within the business sector on the insurance sector? Like, who is advocating? Like, you're the advocacy body for small business.
Yes.
IAG, I wouldn't call us a small business. So, like, what's your advocacy with IAG for the problems that you've described?
And I would call it, as opposed to always being advocacy, I would call it negotiation. I would say it's discussion, and it's ensuring that they are having those conversations internally, which I know they are. Okay.
And what's the outworkings of those conversations? Have you seen any reductions in premiums for small businesses from IAG, seeing as they are a member and you've got a closer relationship with them than Allianz or, CGU?
So, unfortunately, the conditions that are leading to insurance premiums being high haven't changed. So, me having those conversations with them isn't likely to have those impacts, because those external factors also need to change in order for the insurers to be able to make change for small businesses as well. That's my understanding.
I guess one of the very sensible recommendations you've put is that there needs to be better risk assessment that's specific rather than generalised.
Yes.
Are IAG doing that?
I believe they are putting, they are. I'm going to let them answer that tomorrow.
Yeah, okay. All right, fair enough. That's but I guess my point is, you've got a responsibility to small business for whom you're predominantly advocating here today.
Yes.
But there seems to be an inherent conflict there in representing small businesses with a large business that needs to respond to the small businesses, and who's listening to whom, and how do you make those representations? That's what I'm trying to understand. So if you can help me with that in any way, that would be good. And where you've had an impact, getting reductions in premiums for your small businesses because of your advocacy to large businesses, that would be very helpful.
Just to perhaps add extra context to that, though, in my mind, there isn't a conflict there. It's, as we were saying before, this is a system. There is no need for this to be adversarial between the parties. There are different things that each party can do, including small businesses themselves. And so we produced a report last year around the different things that small businesses can do, that insurers can do, that governments can do, that will shift the dial for across the whole system, because it is a system, and there are just levers in place.
Maybe perhaps provide that for us on notice. That'd be good. Thank you very much for your evidence today, Dr. Trembath. And there are some questions I think that you've taken on notice. If you could provide those for the committee by Friday the 29th of May, that would be much appreciated.
Wonderful.
Thank you.
Thanks so much for your time.
I now welcome representatives from the Australian Prudential Regulation Authority. Thank you. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, will you please state your full names and the capacities in which you appear today?
Peter Colhagen, Executive Director, Policy and Advice Division at APRA.
Thank you.
Peter Diamond, Executive Director of APRA.
Thank you.
And Insurance and Banking Division.
Thank you very much. I now invite you to make a short opening statement, if you have one.
We don't have an opening statement, Chair. We're pleased to be here in front of the committee. Happy to take your questions.
Okay. Yes, I do. Great. I'll go straight to Ms. Jarrett.
We've heard a lot of evidence during the day today, and Finity, I asked Finity a question, they couldn't answer it, and they very politely said, ask APRA when you see APRA. So I'm hoping that maybe you can answer it. If not, maybe take it on notice. But they were talking about the importance of how liability insurance has changed. It's undergoing a phase of strong growth, which is now moderating. We're talking growth in terms of premium increases. And they provided a graph which showed that there's been quite substantial increases in the insurance premium rates, for particularly from 19 to 20. FY 20 to 21, 21, 22, it was about the same. Then it started falling off in 23, and then there was a big drop in 2024. And I asked them, is there, how does that relate to various business sizes, small, medium and large businesses, and how much is small business being impacted? Do you collect that level of data?
Yeah, so I understand the issue you're talking about there is the sort of insurance market cycle with the soft markets and hard markets. I think we provided some information in our submission about that. But to the specific question about do we collect data on the broken down by size of business? So the answer there is no, we don't have a single definition of what's a small business to break it like that. Oh, okay. What we do collect, though, is data on what type of measures insurers are using to determine the premium. So we can, for example, that might be things like business turnover or number of staff. So we can draw inferences about what size of business that relates to, but we don't have a firm small business versus medium business versus large business delineation.
So can you help us understand then, I guess looking at the way you collect your data, is liability, because we're hearing that liability insurance and is one of the big costs, and that's increasing rapidly for small business. Are you getting that sense? Do you have something that can indicate to us what is going on in that market? Is it sector driven? Is it? I mean, we just heard from Aki that construction and tourism, etc., of having they're hit the hardest in terms of increases. But what we need, I think, is the data.
Yeah, so we do collect data that shows some of that, and we hear in our engagements with insurers as well about some of the sectors of that part of the market that are particularly challenged. And I think you've probably heard about things like adventure tourism, outdoor organisations, amusement and recreation sector, live entertainment, businesses that are subject to abuse claims. So yes, we do see that coming through the data.
And what particularly is driving it? Do you see, because you said that you measure that you look at the risk behind the insurers and what they're looking at. What are you seeing as the key drivers of this? I mean, we've heard today. We've heard the psychosocial impacts. Is are claims increasing in terms of payouts? Like, what's causing? What are we seeing that's driving this?
Look, I think there's probably an element to which that's quite idiosyncratic to the particular part of the market that we're talking about. But if I take it up a layer, fundamentally what drives insurance premiums is the cost of claims. And so what we understand is the case there in particular sectors is that cost of claims is significant and it grows, and that is the fundamental driver behind why premiums increase.
Is that litigation?
I think so.
Is that what you're
saying?
saying? Parts of it?
I'm not saying it's specifically only litigation, but exposure to risk, the quality of risk mitigation measures at a particular business. I think litigious environment and extent of payouts would be factoring into that as well. I don't know whether my colleague wants to add anything on that.
Sure. I think, as Peter's already said, there's a number of factors that drive into the way insurers price their premiums at this point in time, which includes claims costs, of which a litigation is a part of, and how that changes can drive those costs. Risk levels and risk mitigation, and that's a really big area of focus in terms of how businesses mitigate the risks and their control framework, and how they can evidence that to the insurers. Then there's natural hazard risk and climate risk that comes through, the civil liability frameworks, state taxes and state regulation also has an impact as well, because what applies in one state doesn't apply in another state, and having to manage those kind of complexities adds to the cost as well. So those are just some of the costs that we see insurers have to take into account.
And do you, and maybe you can't answer this given your role in the market, but we haven't actually heard a lot today about risk mitigation and what small business is doing in that space. What are you hearing and seeing from the insurers? Anything that could help us there? Because I think it is like I see some insurers who are, collecting all sorts of data and sending letters out, because my constituents tell me that they get letters from their insurance going, clean out your eaves, stop the flooding that's going into your kitchen. So we are seeing insurers taking that steps in some ways. What are you seeing?
We would be very supportive of them doing that. Anything they can do to mitigate risk and to reduce risk in the businesses is really important. It comes a number of ways. One, it reduces the number of claims that come through, which has to be a positive. But also for them, it means they can charge lower premiums to account for it, because it comes into their risk framework. So they could, absolutely.
But
yes.
Question is,
do they? Are you seeing any?
Or is it just increased profit?
Well, that's a fair challenge. We don't look at how much profit they make per se. That's not what we're here for. Obviously, their profits are public and what they make. What we try to ensure is that they understand the risks that they're taking and they have sufficient premiums to cover those costs, and to ensure that they are sufficiently capitalised for that business. How they charge, and there's a number of factors, including the cost of reinsurance that's part of it. So it's a very complex formula, and any particular profit in any one year can be driven by a multitude of factors, including the costs of climate risk, floods and those kind of events, can have major impacts on particular times. So there's a lot of complexity into their profitability on a particular annual basis.
Yeah, I think that's an important point to draw out, that insurance is a business that's subject to significant volatility. Yep. Some years claims are high, some years claims are low. Insurers need to make enough profit over the course of that cycle so that they can maintain their capital base, so they can maintain their operations and stay in business. And some years that will be, they'll be favourable experience and they'll achieve profits, and in other years they'll have unfavourable experience and they'll be more challenged on that front.
Can I ask a question there in terms of insurance business as opposed to other business? Everybody needs to make a profit. Everybody wants to have some continuity. Yeah.
Is that right? While we're on risk, can I just ask a question on risk?
Sure. Mine is related to, so I'll come to you.
Yep.
I just want to go to where those insurance companies give themselves a ticket out of the market. So we heard this morning that there are market hotspots, which obviously have impacts in terms of the functioning of the entire market here. Mm-hmm. Worker to worker, US exposures, PFAS, music venues, parks and active recreation, religious and educational, agricultural, chemicals, scaffolding and trade contracting. Is it of concern to APRA that these hotspots mean that people in those industries can't get any insurance in Australia? Because that surely has prudential impact somewhere in the ecosystem of businesses.
So I think you've touched on APRA's role here as a prudential regulator. So we're concerned with the prudential soundness of insurers. There are commercial decisions that they make about where they offer cover, on what terms and what price they charge, and sometimes if the risk return that they can achieve through that is not meeting the level that they needed to meet, then they won't offer cover in a particular place. I think from an APRA perspective, I don't think we've got a specific prudential concern with them not offering cover in those circumstances, but I can certainly appreciate that from a whole of economy, whole of society level, that causes challenges to those businesses. Absolutely. Mm.
And your assertion that, there's cycles, some years that they're going to make profit, and the complexity of the determination of overall profit over a period of time. What's an appropriate period to get the profitability? 10 years, 5 years, 2 years, 20 years?
I don't think I would put a specific number on it, but it wouldn't be 2 years or 5 years. We're talking fairly long-term cycles.
Okay. So let's go, is 10-year long-term in terms of what you've just said to me then? Is 10 year in a reasonable amount?
I think 10 years is a starting point.
Okay.
As good a number as any.
So at the 10-year point, they've got a range of businesses that they're supporting or not supporting, as the case may be with insurance product. Mm-hmm. Do you have any oversight about the decisions that they make about their market responses?
So we have ongoing engagement, and Mr. Diamond will be able to add more with insurers about their risk appetite for different types of business, how that's evolving over time, what they're seeing in the market. Our concern, though, as a prudential regulator, where we're concerned about the downside risk, would be, are they taking on too much risk as opposed to too little risk?
I think that's correct, as Mr. Colhagen has said. Our focus is on they remain potentially sound at all times, and what that means for us is that they set premiums that accurately reflect the risk, recoup costs over time, and maintain adequate capital after considering any reinsurance protection that they have to appropriately manage the risks that they have. That's what we focus upon. And if there's more profit than that, we would expect competition to come in and play that role, an appetite to change across the industry to reflect that.
So we've had a bit of evidence today about reinsurance that globals are not reflecting mitigation practices in Australia, and that they are using international aggregated risk assessments that are at odds with what's the practice here in the country. Do you make an assessment about that? Because it wasn't just ACCI who gave us that evidence. There are a number of entities who are saying risk is being assessed, mitigation is being undertaken at some cost, but premiums are not decreasing in a commensurate way. Do you watch or observe that, or is it just the big number and the 10-year thing that matters to you guys?
So I think I would, well, you can take that.
I was going to say that the reinsurance is a matter for what the insurers do and how they negotiate with them. How they reinsure is their choice. It's not our requirement that they reinsure, but obviously the more they reinsure, the more they diversify their risk, the more business they can do as part of it. So it's a choice that they make, and the structure they apply to that reinsurance is their decision. What we do is make sure that the way they capture those risks within their capital framework and the way they look at those risks is correct and reflects what they've agreed to do. And if there's any differences, how that's captured within our frameworks. That's our focus, not the way the reinsurers choose to operate.
Oh, okay. So I was going to say, so you don't pick up the risks that the reinsurers cover as long as they've got reinsurance and that appears. That's a tick?
We would look at how the insurers capture that reinsurance risk within their frameworks. We have a capital framework that applies to the insurance companies. Within that, they have an allowance for the reinsurance that they get. So they have to correctly put that reinsurance into that capital framework, and out of that comes a requirement for the amount of capital that the insurers needs to hold for those risks. So the structure of that reinsurance framework is captured within our capital framework. We don't specify how that reinsurance must look. That's a commercial negotiation between the reinsurer and the insurer as to what they decide to do and how they choose to run their business. What we say is, how you run your business is up to you, but what it means for capital and what we require for you is captured within that calculation that you have to apply.
Okay, and
if I can just add on reinsurance. So the availability of that reinsurance protection, global capital coming into Australia, is very supportive of the ability of insurers to be able to write cover for Australians. So it is insurers access that market, take on that capacity because it achieves a commercial outcome for them, which allows them to write cover for Australian citizens.
And there's one more question from Ms. Jarrett, and then there's a risk question from Mr. Buchholz here.
And that balance that the insurers must hold between reinsurance and capital, pardon my ignorance on this, but is that regulated now, or can that be anything? And if it can be anything, have you seen any increase in the demand for reinsurance by insurers in Australia?
Sure. We don't specify a minimum or a maximum. It's up to the business. The more they reinsure, the less profit they will make because they're paying it away as part of it. But what we do see in Australia, and what our evidence is that as the pricing and structure in the reinsurance market changes, behaviour changes in the Australian insurers. So as that cost comes down, we've seen them take up more reinsurance. As it becomes more expensive, we've seen that change over time. So it's as much a function of the pricing in the offshore reinsurance market that tends to drive the behaviour of the Australian insurers. That's the evidence that we have to
and therefore the prices that they charge, potentially.
I mean, perhaps the best way to think about the role of reinsurance here is that what we specify for insurers is you need to have a certain amount of safety buffer, financial resilience. You can achieve that by holding capital on your own balance sheet, or you can achieve it through reinsurance, which is like renting capital from someone else's balance sheet. So they can choose which one, but ultimately the combination of the two needs to get them to a certain level of safety, and that net number is the number that we're mostly concerned with.
Thank you. Mr. Booker.
Thank you, Chair. Thank you, gentlemen, for appearing. I just want to pick up on your comments around risk mitigation and share two examples that one we've heard today and one I bring. The first example of risk mitigation is a small community in regional Australia, drastically affected by a severe flood event, catastrophic damage to homes, water inundation. As a community, they're told to mitigate. They put levee banks in, they comply, they do everything as a community. another flood event similar to the one that inundated their community first comes, not one house inundated, the mitigation worked.
Mm-hmm.
Everyone gets their insurance premiums. They've increased 75%. The second example is today we received evidence from the Australian Tattoo Guild, who suggested that the risk profile for that particular industry, that the risk assessment being made on that industry, were applying the settings from over a decade ago when criminal organised crime organisations took an interest in that group. They gave evidence to suggest that there are now regulatory hurdles in place about character assessment, etc., and because of the number of outlets, the profitability of the industry is no longer a sense of interest to the crime gangs. Mm-hmm. And so the fire bombings, the cocktails that we saw over a decade ago are no longer part of that industry, yet the same risk assessment is being applied. My question to APRA is, at what threshold does someone have to reach with mitigation that you guys will get involved and say, come on lads, you're taking the piss?
Look, we've spoken about the role of APRA here as a prudential regulator. So we're not a regulator of prices. We're not a regulator of availability of cover. So I'll just put that out there. I think I'm familiar with the risk mitigation, the first risk mitigation example you gave. Well, certainly the example of Roma in Queensland was
Roma, Charlotte, there's a number of them out there, yeah.
Yes, has been quoted in that regard. I'm certainly not close enough to the circumstances of the tattoo industry to offer any informed opinion about that. What I would say, though, is that I understand you've got the insurers, you've got the ICA appearing in front of you tomorrow. I think those are better places for those questions. They don't go to APRA's mandate.
Well, what I would say is these are really good examples to use them and say to them, you say risk mitigation is really important. These are two really good examples that you've demonstrated where risk mitigation. Please explain to us why that is, how you feed that into your premiums and how you've applied that, because that's what I would expect them to do as well, because that's how we expect the system to work. The more you mitigate, the more you reduce the likelihood of risk or the cost of risk, the way that I would expect that to appear in their premiums. And so it's up to them to demonstrate how they've taken it into account.
So APRA has no threshold, APRA has no line of sight to, because I'm just feeding on from your opening comments about risk mitigation. You know, you spoke about your climate risk, the other risks. When there's clearly a demonstrated mitigation and there's no recourse or there's no benefit, there's no space for you to go and have a look at that.
That's not our role here. Our role is to ensure that if there's a claim made, that the insurer is able to and can pay it quickly, and has the capital to pay it quickly, and that it has sufficient systems in place to ensure that it can do that. That's our role, not to opine on commercial matters.
Okay. Thanks, Chair.
Is there anyone charged with that responsibility?
Yeah,
is there anyone in the whole ecosystem that has responsibility for some scrutiny of the behaviours of insurance companies with regard to risk mitigation, connectivity to price, pricing?
I mean, I'd suggest I'd take that on notice if that's okay, Chair, and we can come back with some thoughts on that. But I don't have an answer for you in front of me unless my colleague does. No, I don't.
Okay, great. Back to you, Ms. Jarrett, if you had another question. Okay. Over to you, Mr. Buchholz, if you want to continue.
No, thanks, Chair. That was okay. It was on the back of that risk conversation. I might have something later as it pops up, but
great.
I just want to tie off those two issues, and if it's not your remit, it's not your remit. But
Ms. Lawrence, you have some questions?
Thank you. Can I just clarify, is it the case that APRA can freeze premiums where there's a consideration that they're excessively being high? Does APRA have a role being able to do that as an intervention?
No, we have no such power.
Right. And in the housing context, I understand just from media reports that APRA suggested a centralised insurance register be created to help identify insurance status of properties. Is there anything in that same context that you would be looking to suggest for business, given we have been hearing from witnesses about underinsurance or businesses who aren't able to secure insurance at all or having to self-insure, or do you already have a register capturing that?
We don't have a register that captures that type of data, unfortunately, neither on the housing side nor on the insurance side.
So just to be clear, APRA's data collection powers here apply to insurers, so we would not be in a position to collect data about people who were not insured.
Fair enough. With the insurers, then, sitting there for a couple of questions, if we've got time, Chair. I'd just be interested in your remarks or any remarks you might have around the state of competition within the insurance sector. And I appreciate there's many products being provided to business, but as a general observation, do you have any comments on the health of the sector in context of competition?
I would say that I think here I would refer to one of the figures that you use. If you want to use competition in terms of the way premiums have gone over the last 12 months, and I think as we did in our submission, reflected that premiums have gone down in the last 12 months. If we want to use that as one indicator of the way competition is playing, then we could say that there is increasing competition at that point in time. But I think you as a committee have used examples where there is no insurance being provided, which I think demonstrates again that there is a lack of competition in certain areas that have been attached. So I think we've got two different facts demonstrating that I think it's a mixed picture that we're demonstrating. In some areas there's really good competition and we've seen it come through in premiums, and others there's clearly evidence that there is a lack of competition.
I think what the other observation I would make there is that insurers operate in a global market. There's global capital here. When there are risks that are attractive from a risk-return perspective, we see capital coming into Australia to provide capacity into those markets. But as Mr. Diamond said, that's going to differ significantly depending on the different products that you're talking about.
One of the products we were discussing earlier today was around cyber insurance, and it seems there's some growth happening in the offering of the product, and notwithstanding the against it growing, the market share for it seems to be growing too, and there was a reference to that. There's a number of products on the market, so the premiums are competitive. But how much does APRA look at trends around risks with respect to the cyber example, where we're now seeing a move from ransomware to AI actively attacking systems in a much more aggressive way compared to even 10 years ago? For businesses that perhaps even taken out insurance as a standalone product for cyber, what trends are you seeing, and what does APRA make recommendations? Is there any role for APRA in trying to support like a product of this type where it might be increasingly difficult to actually get genuine coverage for the risk that it is with the advent of AI?
So I mean, I might ask Mr. Diamond in a minute to just comment on anything we're hearing from insurers here, but just to put that in the broader context, the whole issue of cyber risk is one that is of extreme interest to APRA. It's one of the heightened risks in the financial sector that we pay very close attention to. We are engaging constantly with insurers and other participants in the financial system to make sure that they are uplifting their resilience to these issues. We set strong standards around that. We review them, but it's a dynamic environment and it's a constantly evolving threat landscape. So we do maintain very high vigilance on that. We don't have a role directly in I can't remember the word you use, but in sort of driving insurers to offer particular types of products around that. But it is a threat that's impacting businesses across Australia and across the world. So it's clearly a growing risk exposure that people will look for insurance cover around.
We are supportive of the insurers who innovate and develop these types of products. Our frameworks are flexible to adopt that, and as you expect me to say, so long as they capture the risk correctly in the framework, they should be offering this type of product because there is a clear demand for it at this point in time. There is a lot of supply of reinsurance in this type of area.
Yep.
Cyber is a very big area of interest from overshore reinsurers, so there is plenty of appetite for providing that kind of insurance. So I would expect the insurers in Australia would have appetite to offer these types of products because they can fit it within their capital framework and they can have the reinsurance for it as well. But it obviously will come at an impact on price, as you can imagine. But again, that's a commercial decision for them to take.
And this will be a question I'll put to the Insurance Council as well, but trying to understand how a product that can be, at this point in time at least, be offered at a sort of competitive premium and yet seem like the risk of an attack is quite real on any given business. And yet, in other contexts, for other insurance products, the insurance sector just seems to vacate the space or put in so many exclusions that it's kind of like a junk cover for the business to take out, sort of be not fully, covering the risks, in terms of the exposure that they might actually have. Is it possible to explain from where APRA is looking as to how it is that a product for cyber attack can be competitively priced and available, and yet the risk is high, and yet we're seeing, as I say, the walking away for other products, because I'm just trying to reconcile that, because on the face of it, it would seem, why would insurers want to dive into this space when it seems so difficult with AI driving so many of the attacks that they would want to even offer this as a product? Unless there's exclusion.
I would only hypothesise here, and I'm sure the insurers can give you a better answer tomorrow, but it will always come down to the probability of a claim and the cost of that claim, the size of the potential liability that they might be facing as part of it, and whether the insurer is comfortable with that they can estimate the size of that liability and what they might have to pay in that regards. And that uncertainty or that size will obviously be a big driver to the insurer whether they're willing and able to offer that type of insurance at that point in time. So you'll have to get more information as to how they view that kind of liability sizing and risk appetite for a cyber risk versus the other types of insurance that you have. But that, to my mind, would be a big driver of whether they're willing to offer that type of insurance.
And just to add to that, the other side of the equation there is the attractiveness of the premium at which it could be offered for the particular customer. So insurers will have a view about what it would cost them to offer the cover. For some types of insurance and some buyers, the premium will be worth paying for that cover. For others, the demand won't be there if the premium is too expensive.
And if I can, just a broad question here. From where we did all the tort law reforms a quarter of a century ago, what have you had a look at as to what has shifted that has now to see some of the same issues that we had a quarter of a century ago, which were different. The drivers for doing tort law reform there was on the back of a reinsurance collapse. And then I think there was, domestically some massive flow-through consequences on the insurance sector here. But what's changed since then that needs tightening up? Like the disclaimers no longer worth the paper they're written on. Like what shifted that? If you could summarise some of the key things that you think from the reforms that were done to tighten, from professional indemnity, non-feasance, all the different things, Good Samaritan laws, a full suite of things that were done to make sure the legal frameworks enabled access to affordable insurance coverage and mitigating a lot of at that time, a growing litigious sort of nature that was occurring, and trying to nip that in the bud for any frivolous claims. What trends have you seen subsequently in the last 25 years that eroded those reforms?
And that's the last question, if you can, Ms. Lawrence. Thanks.
So that is a broad question. I'm not going to attempt to do justice to that on the spot. There will be parts of that APRA will probably be able to offer some insight on based on our what we can see in the data, based on conversations that we've had with insurers. I'm happy to take on notice what we can provide on that, but I don't think it will be fruitful for me to try off the cuff to summarise 25 years of history there.
Thank you. Can I just observe that you were our great hope in terms of data from what we heard this morning? And now I have concerns about the data that you actually have at your fingertips. And can you just, on notice, find out if there are any agencies that gather data that would give us sufficient shape and form of what's happening in some relevant detail for the differentiation that's necessary to be able to price risk appropriately? Yeah. So that on notice, if I can. 2 questions from Ms. Jarrett, and then I've got a couple that I'll put on notice quickly, and then we'll let you go. Thank you.
Very quickly, you mentioned the competition has led to decreases in premiums for certain classes of business. You can take it on notice, but what are those classes of business and how widespread? Because we've heard nothing like that at all. So that's the first one. And just in terms of your prudential oversight of the insurers, what are you seeing in terms of changes in resilience, if anything?
I mean, I think the short answer there is that we see continued high levels of resilience from the insurance sector.
Okay. I would say that we introduced a particular standard a couple of years ago, CPS 230 as we call it, which is operational resilience. And that was across industries, so for ADIs, for insurers, for super funds, requiring them to uplift their resilience in the operational, which is to map end-to-end their operational processes, identify material service providers from straight third party, fourth party, fifth party, identify all the risks in that chain, and that uplift has taken place over the last couple of years. So we've got clear evidence that all industries have uplifted their resilience to operational risks. A couple of years earlier than that, we did one on cyber, on technology, CPS 234, where we require them to map their technology and to uplift their technology resilience as well. So both operational and technology, there's been a big uplift across all the industries over the last 5-6 years, but that's a continuous journey. Yep. We continue to expect them to continue to uplift all of that over the coming years as well.
Yep. To round that out from a financial perspective, we have very robust standards in place around financial resilience, and we see high levels of capital coverage in the general insurance industry.
Great, thank you.
I just note that your submission indicates that some businesses definitely find it hard to get public liability insurance. Do you see this issue as a prudential risk or not?
No, we wouldn't see it as a potential risk.
Okay. And again, if it goes back to a question, who could possibly observe and intervene if there is anywhere that could occur? Small businesses have raised concerns about the impact of insurance classifications on affordability. From a prudential perspective, do you consider the way insurers develop and apply risk classifications within their capital, actuarial or risk management frameworks? Do you see that detail?
I think we'll have to take that on notice.
Okay, great. And the last one that I want to ask, I'll put up one in writing. I notice it's a bit longer, but you assert that Australia's become increasingly litigious. Could you provide evidence to that effect? And you assert also that it's contributed to rising claim costs for public liability and professional indemnity insurances. In what sectors can you give us some shape and form of that very significant assertion? It's not the only factor, clearly, but it's one that we need to have a look at. I want to interrogate it because I'm not sure that that is the key driver, and often that is the thing that gets the media attention. So to understand it in terms of proportionality, if you could assist the committee with some evidence around that, that would be helpful.
On notice, yes, Chair.
Yeah, on notice, absolutely. Yeah, okay. Well, look, can I thank you very much? We may need to get you back, APRA, seeing as you are the data source they keep telling us we need to come back to. And this is our initial day of inquiry, so we might have some more questions either on notice or as we move further down the journey, get you back to interrogate some of the other things that we acquire in terms of information. Thank you for taking the time to give evidence today. There will be questions on notice. If you could provide them by the 29th of May, that would be good. So that concludes today's hearing. Thank you to all witnesses who appeared and to Hansard and Broadcasting for their assistance, and to the Secretariat for their preparation for today and support in what we do. Thank you also to my colleagues, Mr Buchholz, Mr Senator Sharma, Ms Jarrett and Ms Tanya Lawrence. It's been a good day of gathering evidence, and hopefully we'll be able to use some of this to improve access to insurance and affordability for small businesses across Australia. The committee stands adjourned.